Welcome to Smart Project Concepts. We finally made it. What I call Smart Project Concepts is this is a university grade education in Forex. What you're going to see, there's going to be a bunch of webinars, a bunch of videos down below. All these videos, they are recorded in a virtual class setting. It's like I'm here in the classroom and you're on the other end watching how we present things, present simple concepts on the whiteboard in a virtual class setting. Now, I know a lot of you members are older members of Market Fluidity and you're just getting into Smart Project Concepts watching this. There's nothing new. Some concepts are newer, but some concepts are even more broken down for a better understanding. For people who are new, I welcome you all to the best education in Forex when it comes towards simplicity. As new traders, there are a couple things that happen, right? Psychologically, things go wrong. Mentally, things go wrong. You go into over trading, over risking. But once you truly understand what price is really doing, where market is really moving, how candles are really printing, all these things go away, which is why there are a couple things that we really focus on a lot in Market Fluidity and now coming into Smart Project Concepts. Risk management. Managing risk, keeping your losses small and making sure your winners comparatively to your losses, they seem bigger. Adding risk back to the trade. Let's say you managed a risk. Giving your trades a second chance by keeping the same bias. Adding positions back to a winning trade. All these things, they go hand in hand. And technically, if you really truly understand how price is moving, why is it moving, when there's volume, when there's not volume, psychologically, your whole perception about trading gets better. So take it slow. There's a lot of information. There's a lot of knowledge in this section and the Market Fluidity section. So what I'm going to say is if you are new, if you've maybe been in the Forex market for about a month or 2 months, I would highly recommend to go through the Unlearn and Relearn section in Market Fluidity, and then come into Smart Project Concepts. In future, obviously we have Slack, our community, and also at the same time, now we're going to be not doing any more webinars. Of course, there's going to be simulation webinars every bi-weekly, but mostly what we're going to focus on are going to be virtual classes, like different topics that we can go over in a virtual class setting. So what you're going to see in the future now is this list. It's going to continue to grow and grow and grow, because I think having a virtual class setting is the best form of learning. To be honest, I learned that way much more better than just a webinar. So again, congratulations, you've enrolled into one of the best education platforms on the internet right now about Forex. So take it slow, give it time. Don't expect results in the next month, 2 months, 3 months. Give it at least 6 months to a year, following these concepts slowly and gradually, building a trading plan, refining your trading plan, and you're going to see a light at the end. This has happened to a lot of people. This is still happening to a lot of people, and a lot of new people are going to see that light, are going to see that light of profitability. That's what I call it, right? It's going to happen. So if you think it's not happening for you now, you just got to dial down on your risk, on your trading plan, on the time that you're going to trade, how you're going to focus on all that stuff. So it's game time. Good luck and take care. What's up, everybody? Welcome. Now today, this is going to be the most important section, right? So we're going to talk about risk management. Now a lot of you people, a lot of you guys already know about risk management. A lot of you guys already know how to manage risk, what sort of risk you're going to use, what sort of, like, if that's going to be, you're going to use a static risk, dynamic risk, where you're going to put your stop loss and stuff like that. So we're going to go over all of that. Now, before we start, this section is going to be divided into 3 parts. The first part is going to be about different types of risk or different types of stop losses that you want to use. The first one is always going to be the static risk. The second one is going to be the dynamic risk, right? So these are very important, static risk and dynamic risk. Now, the second part is going to be about where exactly to put your stop losses and how you can use static risk and dynamic risk in actually putting your stop losses, right? So let's say you're going to have a stop loss, and now you have to identify whether you're going to use a static risk or a dynamic risk. Now, before we begin, dynamic risk is a little bit complicated. It needs a little bit of a practice and a little bit of intuition trading. Intuition trading is basically when you're anticipating a certain move, or you're anticipating certain, a retracement or liquidity grab. So that's where you're using dynamic risk. So we're going to go over that too. Now, the third part is going to be the most important part. The third part is going to be how to reduce your losses. right? This is the only way that you can come out of that break-even stage, because a lot of people get stuck in the break-even stage, and the only way to get out of that break-even stage is to understand how to reduce your losses. So we're going to go over all of that. Let's get into it. Okay, first we're going to talk about static risk. Now, whenever we're talking about risk, we are basically talking about risk in terms of 1% to 2% risk, right? So static risk is going to be, so let's say we donate static risk with SR. Static risk is, let's say if you're a trader and you're trading and you identify an opportunity, you're going to use, let's say, 1% risk. That's about it. That's the only thing you're going to use, 1% risk. That's it. Now, next is, let's say you have a $1,000 account, you have $1,000 account, and you want to risk 1%. Now, what's 1% of $1,000? That's around $10, right? So that's around $10. So you're going to risk $10 in the anticipation that a trade goes your way. Very, very basic stuff. Nothing complicated, nothing really advanced at this point right here. Simple. You got $1,000. You're risking 1%, and your risk is going to be total $10. Now, let's say if you're risking 2%, so your risk right here is going to be around $20, right? Now, what does this relate to in lot size? Now, listen. How to calculate lot sizes, how to calculate your risk and pips in terms of lot sizes, it's already explained in our risk management section in market fluidity, right? So go over that. This one right here, we're going to keep it very simple, and we're going to go over dynamic risk. Now, static risk, let's say you have a candle, and the candle is pushing bullish at this point, and let's say we're at support, and you want to take a buy at this point, right? So if you take a buy, you can take a buy right over here. You got your little buy over here, and next candle goes up. Your total risk at this point was, let's say, 1%, right? So you took one position. Let's say this position could be, 10-cent lot. This position could be $1 lot. This position could be, let's say, your 4 lots here as well. So you just took one position. Price went in profits. If price would have came down, it would have hit your stop loss, and you would have lost exactly how much you would have risked. Right, so that's static risk. Very, very simple, nothing complicated, very, very basic stuff. Now, I know a lot of you people have some questions. We're going to keep those questions to ourselves, because as we go along, all those questions are going to be answered. Now, next we're going to talk about is going to be dynamic risk. Now, dynamic risk is where things get a little bit complicated, a little bit advanced, but not so advanced, right? So let's talk about this right here. Now, dynamic risk, we're going to denote this by DR, okay? Now, let's say you're a trader, and you're very disciplined. You don't want to risk a whole lot of money at this point. You're very, very risk averse at this point. So let's say you're going to go with the total risk that you're going to use is going to be 1%, right? Let's say your total risk is going to be 1%. If your total risk is 1%, and you don't want to execute this whole 1%, it's always a good idea to break this down into 2 positions, 3 positions, 4 positions, right? So sometimes what guys do is they'll break this down to 0.5% risk, 0.5 and 0.5, right? Now you got your 2 positions. One position you can enter first, second position you can enter later. Now, sometimes when you enter the first position, and now you want to wait to enter the second position, price may already move. When price already moves, you're only stuck with just one position, and you had no opportunity to add that next position. Now, that has sometimes happened to me as well, right? If I would say a price has to go down, and I would take a sell, and then I would say that I'm going to enter another sell as price retraces. Instead of retracing, prices continues moving, and I'm just left with just one position. That's very, very normal. That comes with using dynamic risk. Now, for example, let's say we have a 2 lot, right? Let's say your total risk, based on your stop loss, based on your the amount that you're willing to risk, you're going to use 2 lots at this point. Now, instead of using 2 lots, I think it's going to be a good idea to maybe break this down into 2 1 lots. Wouldn't that make sense? Like if you're on a setup which you're not unsure about, or which you're not sure about, you may want to break down your 2 lot into 2 1 lots. Or sometimes, we get a setup which is risky. Well, not that, well, let's say if you're not that confident in a setup, and you may want to break this down into 4 positions, and that may be like, 4 0.5 lots. You have 0.5 and you have 0.5. You have 4 0.5 lots. You may break down positions in 4 0.5 lots, and that's what's going to constitute dynamic risk. Now, to break it all down, static risk is where you are using your complete risk, right? And always remember, whenever you're using static risk, you have to manage risk. So we're going to talk about managing risk in the 3rd section of this virtual class. You have to manage risk if you're using static risk. If you're using dynamic risk, you're basically managing risk even before when you're taking the trade, right? So that's the difference. Dynamic risk is where you break down your full risk into multiple positions. Static risk is where you're using the entire one risk. Let's say this is 1%. Static risk is where you're using your complete 1%. Okay? Very basic stuff, nothing complicated. Let's move over to part 2, which is going to be applying static and dynamic risk based on candle conformations. All right. Let's say we have a trend that's coming down. We're going to come up, create resistance, come down. We're going to come up, create resistance, and come down, right? So we have a trend that's moving down. So we have a bearish trend at this point. So whenever we have bearish trend, what are we looking at this point? We're looking at resistances to form, because once we see a resistance forming, then we can identify that, okay, since we have a resistance forming, there's a very high probability that price can continue pushing down, right? So let's say we have a bullish candle at this point, and then boom, we have a resistance formed. Now we have a resistance formed. Now let's suppose this is a 30-minute time frame or a 1-hour time frame. 15-minute may be a little bit tricky, because as we all know, the 15-minute time frame conformations are weak conformations. 30-minute and 1 hour are strong conformations. So let's say price was coming down, we made support, came up, and now we're creating resistance to possibly continue pushing down. Now, in this case, let's say you're looking at this, you got all the conformations, and let's say you also have this range, and this is a 35 pip range, and you're like, okay, you know what, I can probably take a sell over here, and I can have a very, very good trade at this point. And you're going to say, okay, you know what, I'm going to take a sell right here. So you're going to take a sell, and this is going to be static risk. So if you're using static risk, you're maybe using your full 1% trade, or you may be using your full 2% trade, and you're taking a sell, and your stop is obviously above the candle, right? Your stop loss is always above the previous candle. You're taking a sell, and you're anticipating price to go down with your full 2% risk. Price goes down, you make some profits, you close the trade, you're like, perfect, I use static risk, and price went in my favor. Now, remember this. This is very, very, very important. Whenever you're trying to use stop losses, your stops always have to go above the previous candle if you're taking a sell, and it has to go below the previous candle if you're taking a buy. So it's not about how big your stop loss is. It's not about where your stop loss is. It's all about where your stop loss is, not about how big your stop loss is. Like sometimes what guys do is like, you're going to trade gold or you're going to trade pound yen, and you're going to turn around and say, oh man, you know what? I have a very aggressive stop loss. That's just not going to fly over here. Right? If you're looking at 30-minute time frame, you're looking at a 1-hour time frame, you have to make sure your stops are above the previous candle if you're taking a sell, and your stops are below the previous candle if you're taking a buy. Because take a look at this. If this candle has to go down, it has to respect the high of the previous candle, and that's where your stop is going to go. It has to respect the high. I can't stress this enough. It has to respect the high of the previous candle if it has to go down. So that's where your stop is going to go. If for some reason price does not go down, and price, let's say, starts to move up from this point, what are you going to lose, right? If we break above this high, what are you going to lose? How much percentage is it that you're going to lose? You're going to lose 2% because you have static risk, right? You have static risk, so you're going to lose 2% of whatever you risked, okay? That's static risk. Now, let's talk about dynamic risk, which is very important here. And usually I use dynamic risk when, when I'm not too sure about certain moves, so I'm going to use dynamic risk. Static risk, most times I use static risk because I can manage risk. And we're going to talk about managing risk in the third section on static risk. So now dynamic risk. Dynamic risk, let's say you have, or you want to risk 2%. You're risking 2% and you're going to say, okay, you know what I'm going to do? I'm going to break this 2%, my risk, down into two positions. So you're going to break this down into 1% and 1%. That's what you're going to do. You're going to break this down into 1%, 1%, and now you have two positions. The first position, you're going to say, okay, you know what? I'm going to take the first position. Now, these are all hypothetical situations, right? Candle can move up to make a wick, or candle can move down, right? So what happens in this point is that you're taking a sell as soon as the candle starts. So this is where your first position goes, 1%. You're using dynamic risk. Now, if price goes up, this is where your stop loss. Now, if price hits your stop, how much are you losing at this point out of your 2%? You're losing 1%, okay? Because maybe you're not sure about this position, you're a new trader, this is a setup that you've been watching for a long time and you're executing on this for the first time, so you're being very cautious of the risk you're taking. So if price hits your stop, you're losing 1%. Now, there are different variations. Sometimes what guys tend to do is that as price retraces, they will add another position, and this is going to be another 1%. They're going to add a position, right? And the stop is going to be at the exact same place. Now, what's the difference between the first position stop loss and the second position stop loss? The first position stop loss is wider, right? The second position stop loss is smaller at this point, but now you have an opportunity to get a better price for this potential sell, right? Now, let's say price goes up, it does not break the high, it respects the high and starts to go down. Now you're in the money. At this point, you're in the money. How many people have, executed on candles that have been moving up, and you're anticipating the candle to make a top wick? And you're anticipating the candle to make a top wick, and then price starts to go down in your favor. You're like, oh yeah, isn't that a great feeling? When price starts to go in your favor at this point, without breaking the high, so we respect the high, you took your second entry right here, price moved in profits, and you're like, okay, you know what? Perfect, I won the trade, awesome. Right? Now, the second scenario here. Second scenario that happens at this point is going to be, let's say you have taken a sell, right? And this sell is the dynamic risk that you've taken just as soon as this candle opens, so you took 1%. Now, price retraced, right? Price retraced, and you're like, okay, you know what? Price is retracing. I don't want to enter a position as price is retracing because I find it very, very risky, because if I enter a position and price hits my stop loss, I'm going to lose 2%. So if it hits my stop loss, I'm okay with losing 1%. The number one rule of managing risk is to always be okay with how much you're going to lose. That's the number one rule. Write it down. I'm going to wait. Write it down. Always be okay with how much you are going to lose. Accept that fate that you're going to lose that much, right? So if price retraces, it's going to hit your stop, you're going to lose 1%, so you're not going to enter a second position. What you're going to do is, what I like to do most times is that if I'm going to go for a dynamic risk, as price starts to come back down and start to form bearish, I'm going to enter another position right over here. My second 1%. Because what I'm doing is I'm anticipating that if a candle has a top wick and a bottom wick, right? If a candle has a top wick and a bottom wick, and if price is breaking its own low and trying to go bearish, I'm anticipating that, okay, maybe the candle has made that liquidity wick. Now, some questions may happen that, should this happen in the first minute or the first 2 minutes or the first 3 minutes, 5 minutes? That's besides the point. We're not going to talk about that. When a candle moves in the first minute, 2 minutes, I that's basically how many times have you seen that happen. That comes with experience. It comes with intuition. You know, whether you're going to enter in the first minute, 2 minutes, 3 minutes. Over here, we're only going to talk about very simple stuff, and that simple stuff is going to be, let's say, for example, that the first half of this candle made the top wick, right? And if it starts to go down in the second half, now I'm anticipating that, okay, maybe the first half made a top wick, and now in the second half, we're trying to go down, and that's where I'm going to enter the second position. Right now, if let's say that I want some extra confirmation, maybe this is what I'm going to do. And this is what I usually do as well. If I want some extra confirmation, and some of you already have that answer in your mind, it's going to be once this candle starts to break the low of this previous candle, second position will go right over here. And guess where the stop is going to go? The stop is not going to go above the previous candle. The stop is going to go above this current candle. And then you can trail your previous stop above this current candle as well. Because guess what? If we're breaking the low, then there's no reason for price to come up and break its own high. Because if price is making a lower high, which is lower than the previous candle, and it's breaking the low to make a lower low, where are we going? We're going down. Okay? So that's what I'm doing. Dynamic risk. We talked about two situations, dynamic risk. First, you enter at this point. Second, you enter as price retraces, but that depends on confidence. The second one, you enter as we try to go bearish, or, sorry, we talked about 3-1, or you enter once we break the low. I find in dynamic risk, what's more useful is that you enter when the candle starts, and then you know, the second position, if you really want to take a second position, you take that position as the candle breaks the low of the previous candle. That's what you do. That's what I've seen that has worked for me as well. And I've seen, like, you know, a lot of people have done that as well in our group, Slack group, YouTube, whatever. Now, let's say you're entering your 1% at this point. First position goes right here. And now you're going to say, okay, you know what, I'm going to enter the second position as price retraces, but instead of retracing, we create a tiny wick, and then price starts to break the low. In the first minute, or 2 minutes, 3 minutes, whatever, price starts to break the low, and you're like, oh, we're breaking the low. I don't know if it's breaking the low to retrace up. If it retraces up, that's a whole other thing, right? So we're not going to discuss that. If price breaks the low and starts to go down, now you only have 1% running, and you're like, oh, okay, you know what? I had no chance to enter the second position. Now, that has happened to me a lot sometimes too, where I basically had no chance of where to enter the second position. You know, so you got to take it how market gives it to you. That's the bottom line, right? Now, for example, instead of using two positions, you're going to say, okay, you know what? I'm going to be a little bit more risk averse, and what I'm going to do is I'm going to break this down into 4 0.5 lots, right? 1, 2, 3, 4. I'm going to break this down into 4 0.5 lots, right? So you can basically do the same thing. You can enter the first one right here, 0.5 lot, price retraces. There goes the second one, 0.5 lot. Your stops are right up over here above the previous candle. If candle retraces further more, you're going to lose 1%. You know, you're not losing much. You're just getting better prices, right? If price starts to break the low of the previous candle, there we go. You can enter another 0.5, or you can enter 2 0.5s, or you can enter, you know, a full 1%, making your total risk up to 2%. Go over the section again, right? Making your risk up to total 1%. So there are different variations how you can use your dynamic risk. And dynamic risk is very, very, very powerful because, you know, it teaches you the idea of managing risk. It teaches you the idea of how to average in positions as price goes in your profits or price goes in your direction as it's moving. And the same thing applies for if it's the opposite way, right? If price is moving bullish at this point. But always remember, as we talked about in some sections, that when you're trying to sell resistance, you're only selling resistance when we are in a downtrend. And you're only buying support if we are in an uptrend. Very, very important concepts, right? Very important concepts. Now, the third part, most important part, how to manage risk. How to make sure that you lose less than what you anticipated to lose. This has kept me out of trouble so many times. Like a lot of people, they see the streams, they see the history, they see the results, and they're like, man, how can you lose so less? How are you able to lose so less? And let me tell you this right now. It's not all the time you're going to be able to manage risk. It's not all the time that you're going to be able to close 50% or close 60% or close partials as candle highs get broken or the lows get broken. It's not going to happen all the time. There's a probability. Sometimes as price goes against you, you will lose the entire percentage, right? But most times you're going to have opportunities to manage risk. Sometimes you're not going to have opportunities, and that's just the odds of trading, right? But most times, I stress this again, most times you will have an opportunity to cut your losses short. So, together, let's take a look at this right here. Now, let's say, for example, price is at a support, right? Price is at a support, and we're going bullish. We're in an uptrend, and price, if it wants to go up, it needs to create a support. And you're looking at, the high created up over here, and this candle, basically, we came down, and you're looking at a support to be formed, and boom, you have a support formed. This is your high at this point, and let's say that this range is about 40 pips, because this is a pound, yen, or gold, or whatever pair this is, right? You have 40 pip range, trend is up, and we've created a support. Now, we've created a support. Now, let's say this is a 30-minute time frame, so we're going to mark this down right here, right? So this is a 30-minute time frame, and now you're saying that, okay, there's a high probability for the next 30-minute candle to continue pushing up. So what are you going to do, right? Let's say, for example, that we're going to use static risk. Managing risk is always good when you're using static risk. When you're using dynamic risk, your risk is already managed. There's no, further managing risk on a dynamic risk. You're basically over-managing risk. And trust me, that's a term. When you over-manage risk, that's a term. Like a lot of you guys were watching this again from Market Fluidity. I understand that some people over-managed risk, and that's not good. Don't over-manage risk, right? Only do it once or twice. So let's say static risk. So you're going to say, okay, you know what? I'm going to enter a buy right over here, right? You're going to enter a buy, and this is going to be, let's say, 1%. You're risking a total of 1%, and you're going to take a buy at this point. And obviously, your stop is below the previous 30-minute candle, and now you're anticipating this candle to respect this low and then to continue pushing up. If it continues to push up with respecting the previous low, awesome. You got a winning trade, you got full 1%. Now, let's say, for example, now we're going to break down this 30-minute into 15-minute candles. Let me do this. So let's do this. I'm trying to see where we have clean area. Okay, let's do this right here. So let's say, for example, that this 30-minute candle represents two 15-minute candles that look like this, right? You got two 15-minute candles. Oh, made a mess about it. So you got two 15-minute candles that look like this, okay? Now, you have the new 30-minute candle starting now, which means that you're trying to take a buy on the next 15-minute candle. So you take a buy right over here, and that denotes a 30-minute candle right over here. You've taken a buy, and this is where the candle starts. Now, if this 30-minute candle respects the previous 30-minute candle's low, your trade is still valid, and then, price can go up. What this means for the 15-minute candle is that if this 15-minute candle starts to go bearish, and it closes bearish, now there are two variations, right? Remember, if it closes bearish, you have to close 50%. So from here, we're going to close 50% of the trade. If you had let's say a 1 lot running, you're going to close 0.5 lot. If a 15-minute candle closes bearish, and I'm going to tell you why. The reason why is that if the 15-minute candle has closed bearish, then there's a probability maybe the next 15-minute candle can continue to go down. And if the next 15-minute candle continues to go down without you closing 50%, now you're going to lose your entire position. Okay? Because if price has to go down, you have to remember, don't let your complete position go in a drawdown. The idea of managing risk is to never let your full position hit a stop loss. That's the whole idea. So the first variation is when the 15-minute candle is closing bearish, boom, 50% off the table. No matter what, 50% off the table when a 15-minute candle closes bearish. Now, if, let's say for example, the 15-minute candle does not close bearish, and if the 15-minute candle breaks the low, right, let's say that this candle is still open, breaks the low of the previous candle, this one, boom, 50% off the table, 100%. Because if it's breaking the low and respecting the high, what are we doing? We're making a short downtrend at this point, right? If the 15-minute candle respects the high and breaks this low, 50% off the table, 100%. You're taking 50% off the table. You're not giving market a chance to take your complete stop out. That's the deal right here. Because if it has to go up, it has to respect the dynamics on the smaller time frame as well for buys, right? If it has to go up, the 15-minute candle has to respect this low and then continue to push up, and overall making the 30-minute candle go up as well. It has to respect the low. 100%. It has to respect the low. Now, there's a question that may be coming up, and that question would be, oh, but what if a 15-minute candle closes bearish, okay, and we close 50%, and obviously this first 15-minute candle is the half of the 30-minute candle, right? What if the second 15-minute candle starts to go up and then continues to go up on the second one? Then what are you going to do? Well, in that case, you're going to be using the concepts we talked about in how to give your trade a second chance. Or you're going to use the concept we talked about, adding positions to a winning trade. Now, if it does start to go up, that means that maybe the first half of the 30-minute candle wicked down and the second half started to go up. But honestly, I've seen this happen very rarely, very rarely that we've had a bearish 15-minute candle and then the next one has gone up. It does happen very, very rarely, but it does happen, but also at the same time, it's also very important to be risk averse, right? You have to mitigate risk. It's very, very, very important. So whenever I'm using static risk and I'm looking at the 30-minute time frames, if the 15-minute candles break the previous low, I'm taking 50% off the table. Right? If I'm taking a sell on the 30-minute time frame and the 15-minute candles are breaking the high of the previous 15-minute candle, I'm taking 50% off the table. If we do continue to go in our direction where we thought price was going to go, then either I'm going to let whatever's left is run, or if there's an opportunity, I'm going to add that risk back to the trade. And that's what we've talked about in another section here as well that you can look into. Okay, when we're using dynamic risk, there's basically when you're using dynamic risk, you can't really manage risk because from the get-go, you've already managed risk on that dynamic risk. Because if you're using, let's say, total 1 lots right here, so dynamic risk would basically mean that let's say you're breaking this down into one 0.5 and another 0.5, right? So you're taking 0.5 right here, and you're taking 0.5 right here as a new 15-minute candle is forming. That's basically managed risk there anyway, because your total risk is 1 lot, and you have a 0.5 open, and you're basically entering the second position based on what we talked about earlier, right? So dynamic risk is perfectly fine. Whenever you're using static risk, that's when you're managing risk. Right, now, risk management, it takes practice, it takes time. Don't assume that you're going to get really good at managing risks. It's going to take time. It's going to take time to accept losses. The biggest problem people have is to really accept your losses. If you're not going to be able to accept your losses, you're going to overtrade, you're going to over-risk, and you're just going to compound your losses. Man, trust me, if you have a solid trading plan, right, and your trading plan says that you're only going to risk 2% or 1%, and you're going to manage risk on those trades, your trading plan is going to be rock solid. Your trading is going to be amazing. You're going to have a higher confidence. Your ego is going to be up. You're going to be more confident in executing trades, knowing that you can manage risk. And also, another thing, right? And this happens to all of us. Whenever we increase our lot sizes, guys say, oh, you know what, I'm super scared, I'm super anxious to increase the lot sizes. Raja, you have any tip? The biggest tip is this. Whenever you're increasing your lot sizes, just understand that you can manage risk. If you're going up from a 50-cent lot to a 1 lot, and you're kind of like scared at that point, just know this, that what's the worst that's going to happen on a 1 lot, right? If your stop is, let's say, 12 pips, for sake of simplicity, 12 pip stop loss, 1 lot, you may lose $120. But if you know how to manage risk, you may lose $80, right? You may lose $70. So that's a win in itself. If you're defeating your risk and you're losing less than what you planned on losing, that's perfect. And before we end this, understand this very, very carefully, right? In the start, it's very normal for you to focus on wins. It's very normal for you to focus on making the most amount of money, the biggest trades, and the best trades. That's perfectly fine. But what happens in the beginning? Everyone starts to lose money. So what are you going to do at this point if you start to lose money? Are you still going to focus on making great trades and great wins and lots of money, and you're going to keep overtrading, over-risking? No. The only thing you're going to do is to focus on how to stop the bleeding. And bleeding here means you losing money in the markets. You can't do that. That's the first thing you need to focus on. And honestly, in the beginning, when I first started, if someone would have told me, hey, Raja, listen, what you got to focus on first is how to manage risk. And what we did in the beginning was to how to make the most money, how to compound the most money, how to keep compounding and making these millions and gazillions, hundreds of thousands of dollars. No, it all came down to now. What I know now, if I knew this back then, my trading journey, very easy, very quick, very robust. You know, because in the beginning, we have to focus on manage risk. Take pride that you can manage risk. Whenever I lose a trade, I take pride in that, because my loss of a trade, it determines that, hey, you know what? I wanted to lose 2%, but I lost 1%, or I lost 1.5%. So in a way, that's also a win for me, right? Now, watch this virtual class again, and there's some things that you really have to incorporate in your trading. If you don't incorporate these techniques in trading, these even psychological techniques, that it's okay to lose, but lose less, aim to lose less, even ending the day with losing less than you planned is a winning day in itself, trading will be very easy for you, very simple. There are a lot of people in our groups here that do the same. They lose less, they have a strong command on their risk management that they can lose less. And that's where you win more. Because at the end of the day, you cannot control the amount of money you're going to win. Because price is just going to go where it wants to go. You can't control that. But what you can control is what you're going to lose in the markets. Take care. How's it going, everybody? So in this section, we're going to talk about how different sessions, they influence different time frames. Now, before we get into the depth of that, we have to understand this one thing. When do we have big candles forming, right? What are the times when we have big candles forming? Because as we've discussed before, the bigger candles are only going to form when there's going to be volume in the market. Let it be the 4-hour candle, the 1-hour candle, 30-minute candle, 15-minute candle, whatever candles there are, right? The bigger candles are only going to form when you have volume in the market. We have to understand this one thing. So now, what we're going to talk about is going to be the 4-hour candles, and we're also going to talk about which sessions influence the 4-hour candles, because the 4-hour candles obviously have to be bigger. And we've also talked about that whenever you're trying to take a trade, you have to make sure that a candle is going to be a bigger candle. If you're missing out on those trades, you have to understand that, okay, when did this big candle form? Did this big candle form because there was volume in the market? Did this big candle form because there was a market open, pre-market open? Was there any news events at that time? Was there any breaking news happening? Sometimes you're going to have bigger candles form when there's going to be no volume in the market, right? Before the market opens, before even the pre-markets open, that's going to happen. So once we get into this, you're going to understand that how sessions are going to influence your time frame. Then specifically, we're going to talk about the 4-hour time frames. Okay, to start this off, we know that there are 6 4-hour candles in one daily candle. So we're going to write them down right over here. So we have the first 4-hour candle, 1, 2, 3, 4, 5, and 6, right? So we have 6 4-hour candles, and these 6 4-hour candles, they make the overall daily candle, right? Now, whenever we're looking at the 4-hour candles, we understand that not all 6 4-hour candles are going to be bigger candles, because some 4-hour candles are going to be smaller, some 4-hour candles are going to be bigger, right? And we also understand that if we have one daily candle which looks like this, a bigger one, we understand that maybe there were only like 2 4-hour candles that made the daily candle bigger. Maybe there were 3 4-hour candles that made the daily candle bigger. So these things we have to understand. So we're going to talk about which sessions influence these 4-hour candles. Now, let's take a look at the first one. Now we need to understand when this first 4-hour candle starts. The first 4-hour candle normally starts at around 5 p.m. and goes till 9 p.m. Eastern time, right? We're only talking about Eastern time right here. The first 4-hour candle starts at 5 p.m., goes all the way up towards 9 p.m. Eastern time. Now, we have the second 4-hour candle. Now, once we're looking at the first one, which sessions fall in this first 4-hour candle? It's very simple. Which sessions fall in the first 4-hour candle? It's your pre-Asian and your Asian open. These are the 2 sessions that fall in the first 4-hour candle. Now, sometimes we do have the 4-hour candle, the first one, which is a bigger candle, right? That's when we can say, okay, what? Maybe in the Asian session, there was a lot of volume, and maybe that volume really pushed the 4-hour candle. Now, next one, next 4-hour candle, it starts at 9 p.m., goes all the way up towards 1 a.m. Eastern. What's this time? Do we normally have volume during this time right here? Do we have volume during this time? Probably not. We don't normally have volume at this time. So normally, most of the times when you take a look at your charts, you're going to understand that this 4-hour candle is mostly a small candle, right? A small candle because there's no volume at that time. The 1-hour time frames are consolidating. The 30-minute time frames are consolidating. That's why we always talk about that. Always make sure you're taking a trade when there's volume in the market, right? After this, we have the next 4-hour candle. And this 4-hour candle starts at 1 a.m., goes all the way up towards 5 a.m. Eastern. Now tell me which session falls in this 4-hour candle. You have your pre-London. So in this session right here, in this 4-hour candle, you have your pre-London and your London open. These are the 2 sessions that fall within this 4-hour candle. So normally when you're going to take a look at this 4-hour candle around this time, you're going to notice that this 4-hour candle is going to be a bigger candle. It's regardless the fact that maybe the 1-hour candle printed the 4-hour candle bigger, or one 30-minute candle made a 4-hour candle bigger, but the fact is that most of the time during this time right here, 1 a.m. and 5 a.m., you're going to see that the volume is going to be in this 4-hour candle. So the point is, when you're trying to make a trading plan, right? Whenever you're trying to make a trading plan, you have to choose that which time frame you're going to choose to trade. This is very, very, very important. The most important aspect. Next, we have from 5 a.m. We have 5 a.m. all the way into 9 a.m. Eastern. We have another 4-hour candle. Now you need to understand that which session falls within this 4-hour candle? And the answer is simple. You have your pre-New York and you have your New York Open. You have two sessions, high volume sessions, but also don't forget that these two 4-hour candles are the most volatile 4-hour candles. The most amount of volume that's in the market lies between these two 4-hour candles. And sometimes, like, you know, there's a lot of volume in this 4-hour candle as well. So let's talk about that here first as well. So this 4-hour candle, we have 9 a.m. going all the way towards 1 p.m. Now, which sessions fall in this 4-hour candle? Let's talk about that. We have the NYSE Open and we have London Close in this 4-hour candle. Let's talk about the last one. This last 4-hour candle, we have from 1 p.m. all the way till 5 p.m. And normally there's not enough volume in this 4-hour candle. So because, you know, price is consolidating, London is closed, Asian is closed, we're coming up to a close of the New York session. So normally there's no volume and normally I don't see anyone trading at this time. So the only bigger volume time frames or the only bigger volume sessions we have, they lie between these three 4-hour candles. We have 1, 2, and 3. So whenever you're creating a trading plan, you have to understand that, okay, which 4-hour candle am I going to focus on? Am I going to focus on the third 4-hour candle, which is where you have your pre-London and London Open? Am I going to focus on the fourth 4-hour candle or the fifth 4-hour candle? Because that's the idea, because you're only looking to trade when there's volume in the market. Because trust me, whenever you're focused on, because, okay, here's the thing. You're only trading one hour candle or one 30-minute candle. And we've talked about that in breaking down the higher time frames and the lower time frames. But right over here, we're only talking about how sessions are going to influence your 4-hour time frames, how sessions influence your time frames. So whenever I'm looking for a trade, I'm looking at where the next 4-hour candle is going to go. If I see that I have consolidation happening on the second 4-hour candle, I automatically understand that, okay, if we have consolidation happening on the second 4-hour candle, maybe the third 4-hour candle is going to be the move. Maybe the third 4-hour candle will move price where it has to go. So you have to visualize how the third 4-hour candle is going to form. And then you try to understand that, okay, you know what, the third 4-hour candle, it has my pre-London and my London Open. So maybe there's going to be a lot of volume coming in from these time frames. So I have to be ready to anticipate where the 4-hour candle is going to go. If there's no volume during these times, then the 4-hour candle basically isn't that big of a candle. Then you're trying to see that, okay, we probably consolidated, or let's say we had volume during Asian 4-hour candle, and then we had no volume during this time, and then all of a sudden, the pre-London and London Open 4-hour candle starts to consolidate right here. So maybe we're going to have volume in the fourth 4-hour candle, which falls in pre-New York and New York Open, right? So whenever you're trying to see when you're going to trade, you're trying to anticipate where the 4-hour candle is going to go depending on which session you're looking at. So whenever you're trying to make a trading plan or whenever you're trying to see that which time you're going to trade, you have to focus on just one 4-hour candle. That's what I've done. That's what I've done for the past 5 years, 6 years. Only focused on one 4-hour candle. And we've talked about this a lot of times. Whenever you have a candle moving, there are billions of dollars moving in that candle. So your job is to just scratch the surface of that candle. Hope this helps. We're going to move on to the next section. Take care. What's up, everybody? So in this section, we're going to talk about zones and ranges, right? Now, a lot of people, they confuse the difference between zones, what are ranges, how big should a range be for you to take a trade? If we're within the range, what should we do at that point? If price is at a probable zone, what's going to happen? Will that zone break or will that zone be respected? Stuff like that, right? And it's very, very important because once you see these situations happen in the charts, you start to second guess yourself. You start to think that, okay, maybe this is going to work, or if it's not going to work, or like like, price has left a zone or price has left a support or resistance. Should I take a buy over here, or should I take a sell over here, or should I wait for a retest, right? So the biggest question is, if we're in a zone and you have a range in front of you, or like, if you have a clean range to the left-hand side, the biggest question is that, should I wait for a retest? Or should I just do an impulse entry for price to go wherever I think price is going to go, right? And a lot of people get confused in those different scenarios, right? So we're going to talk about that, and we're also going to talk about when zones are basically broken, like what times you have when zones are broken, when are they respected. So let's get to it. So first things first, let's say we have a resistance, right? And this is your regular resistance right here. Now, when you have a resistance, you have to understand that a resistance is not a specific price, right? Because when I first started in the beginning, I would look at that and I would say, okay, you know what? It's a specific price. Let's say if you're looking at pound yen, I would say, okay, you know what? This is basically, let me just do this right here. I would say, okay, my resistance is at 160, 500. Right? Ideally, it's not at 160,500, because this area you see, these are collection of prices, right? This could be between 160, let's say 160, 450 to 500. It's not always 160, 500. So whenever you're taking a look at charts, whenever you're trying to see where your resistance is, it's not a specific price. It's the range of prices. So that's what your resistance is right there. It's a range of prices, right? So that's your resistance. Now at the same time, let's say we have a support area down over here at this point, right? So you have your resistance, you have your support. Now, a zone, right? So this is your zones. A range is the distance between two zones. That's your range. So the distance between these two zones, let's say this is a distance of 30 pips. This is your range right over here. A range is going to tell you that whether or not you're going to have a higher probability to win a trade or not. That's what the range is going to tell you. Now, for me, if I like to take a trade, I like to have a range of about 30 pips, right? This could be, let's say, for example, if price made a high right over here, price came down, created support, and now you could say that, okay, like, you know what, maybe this range is 10 pips. If you have a 10 pip range and you want price to retest the high at this point, this is a very, very small range. It's not going to work out for you, right? So we're going to imagine that this 30 pip range doesn't exist, and we're going to say that, okay, like, you know, maybe if this is a 40 pip range, if this is a 40 pip range, this is going to be a much better idea for you to execute on a trade. Now, let's start from the very, very basics, right? So you have two zones and you have a range in the middle, okay? And for better explanation, let's say this is a 40 pip range. Ideal range. For me, an ideal range is between 30 and 40 pips. Sometimes, you know, like I can execute on a 20 pip range or a 25 pip range, but it all comes down to experience. It all comes down to how many times have you seen certain things play out in the market, right? So in this case, we're only going to take a look at a 40 pip range. Let's say your range is 40 pips. Now, for example, now let's say you have a candle and like, you know, this candle is closing bullish here in this range. Now, if a candle is closing bullish in this range and you got a 40 pip range, and if you're saying that, okay, like, you know what, the next candle has a higher probability to continue up towards our resistance zone, the best opportunity is going to be to anticipate the next candle to wick down without breaking this low and to continue pushing up. Even though this is a 40 pip range, understand this one thing. Now, I hope people are making notes. Understand this one thing. If you have a 40 pip range, it's not always that price will reach to the opposite end. It's not going to happen all the time, right? Which is why whenever you take a trade in a 40 pip range or a 30 pip range, you are securing what you can secure, like, you know, 15 pips, 20 pips, 25 pips. You can easily secure in this 40 pip range, no problem. But also note that the candle is near this zone. The closer the candle is to a zone, the better the probability that you can have a winning trade, right? What I mean by that is like if a candle leaves the zone, let's say you have a candle at this point and the candle leaves the zone, the further away a candle moves from a zone, the higher the probability that it may come down to do a retest. Now, there's one thing that I've seen traders do all the time, whether you're coming from YouTube or you're already in market fluidity. I've seen this thing, where people do this all the time. You're going to have a candle closing away from a zone. Let's say that this zone here doesn't exist. Let's say we have clean candles to the left-hand side, and we've moved further away from the zone in a manner that a candle closed like this, right? Well, now what guys are going to say is that, okay, since we have volume at this time, we're going to anticipate the next candle to wick down, break this high, and then continue to push up. Now, on paper and theory, this looks good, right? This looks good, but the probability of price moving further up, it becomes lower than the probability of price retracing to create support, unless you have a lot of volume, right? Unless you're running at pre-London, you're running at London Open, unless you got a lot of volume, it's going to be a very low chance that price will continue to push up. Most probably what's going to happen is that price may move up and then it may continue on pushing down. This has happened to a lot of people in the past as well. Price may do something like this, like moves up, breaks the high, comes back down and closes a bearish candle like this, and now you're left holding the ball on the losing side, right? So whenever you have a candle that's breaking outside of a zone, and it's I would say maybe if it's 15, 20 pips away from a zone, there's a high probability it's going to do a retest. I'm not going to execute on that candle. I may execute when price comes down to do a retest. So ideally, what I would want to see is that whenever you have a candle that's breaking above a zone, it needs to be closer to the zone, right here, okay? Because, listen, the closer the candle is to the zone, the higher the probability it's going to leave that zone, especially if that's a 30-minute time frame, 15-minute, depends on the situation, depends on the amount of volume. 1 hour time frame, 30-minute time frame, they're awesome. If you have a candle that's closing at a zone, like a 30-minute zone or a 1 hour zone, it has a higher probability to leave that zone, or it has a higher probability to reject that zone. For example, let's say we move back to our resistance at this point, right? And this is your 40 pip range, and if price comes up, your price is at at a resistance at this point, and we're basically creating a resistance right over here. If we're creating a resistance right over here, and this is a 1 hour zone or a 30-minute zone, then there's a higher probability it may continue to push down. There's a high probability. Now, I'm not going to say that this is valid in a range. Even if you have a range, you have to take this trade when there's volume in the market, like pre-London, London Open. And this range also has to be like a 40 pip range, like a 35 to 40 pip range. Sometimes we can have a 30 to 40 pip range, but price is just not really moving. Candles are not that big enough. Sometimes you can have, a 25 pip range. If you have a 25 pip range, and you're taking a sell right here, what are you trying to get? If this is a 25 pip range, let's say an average spread is 1.5 pips to 2 pips. Now you're left with a 23 pip range. 23 pip range. What are you trying to get? 10 pips out of it? No, man, nothing. It's not going to work like that. Now, another thing that I see people do all the time is that, okay, so let's remove this area here, right? Let's remove this, and let's remove this, and let's do something like this. You got a support area, you got a bearish candle closing right here, you got a okay. The reason why don't take a sell within the range when a candle is in the middle of a range is because when a candle is in the middle of a range, there's a 50-50 chance. There's a 50-50 chance whether the candle is going to go up or it's going to go down. There's a 50-50 chance because now we're in the middle of a range. And even if this is, let's say, a let's say it's a 45 pip range, right? If we're in the middle of a range, even though you can say, okay, you know what, hey man, we got a 20 pip range to move to the downside, 20, it's still in the middle of a range. You have to look at probabilities, right? Probabilities. Probability dictates that there's a 50-50 chance that the next candle may move up or it may move down. There's a 50-50 chance. So we only have to execute when the probability is in our favor, right? Let's say we are right over here. We are right over here. Right? It's closer to a zone right here. The closer price is to a zone, or the closer candle is to a zone, there's a higher probability for price to reject that zone, or for price to leave that zone, right? So now, whenever we're going to talk about sells after resistances, we're talking about sells after resistances in downtrends. Whenever we're going to talk about buys at supports, we're only going to talk about buys at supports in uptrends. Perfect. Hopefully we're all making notes, right? So, this is the basics. You got your zones and you got your ranges. Whenever you're trying to take a trade, you have to make sure you have a big range, like a 30 pip range, 40 pip range. You know, on gold, you can easily get a 40 pip range. These days, there's a lot of volume in pound yen. You can get an easy 40 pip range, 30 pip range. As you go down ranges, like let's say as you go down towards, like a 25 pip range, for you to get that trade or for you to get that move gets a little bit harder, because then you're anticipating the candle to move like 10 pips, 15 pips, 20 pips if you're lucky. So that's what happens right there. So whenever you're taking a look at your ranges, first thing first, you need to see how much of a range do you have. If you have a 40 pip range or a 30 pip range, you're like, okay, perfect. I got a 30 pip range and I can execute a trade in that range. Okay, awesome. Second is, where is the candle closing? Where are you taking an entry? Are you taking an entry near a zone? Right? Are you taking an entry near a zone? Or are you taking the entry once price has left the zone? If you're taking an entry when price has left the zone, the chances of you winning the trade is 50-50. And we're not in this business to make money on a 50-50 chance. We're in this business to make money where the probabilities is in our favor, right? So always you have to make sure that you're trying to execute when price is near a zone. Because then when there's volume can push price down. Or from here, volume can push price up if we're near a zone at this point. Right. Now, zones and ranges, they may seem simple, but when price is moving, FOMO gets in the way, over trading gets in the way, revenge trading gets in the way. We really need to control that. Those feelings are really going to fuck you over in the markets. Okay, so you have to understand, whenever you're taking a look at the charts, you have to measure how much range do you have. Is it even a tradable range, right? If you're looking at a tradable range, do you even have clean traffic to the left hand side? It's very important to have clean area to the left hand side where price has moved easily to the left hand side in the past, and now you can expect price to move there easily as well. So again, I'm going to reiterate everything, right? First things first, you need to know where your zones are. Once you have your zones, you need to understand how much range do you have between those zones. If price is going to break resistance, do you even have enough range for price to move in? Because if you have enough range for price to move in, that means you can grab a part of that move. Not the whole move, the part of that move. If you want to grab the whole move, then you're maybe, you're letting a runner run. You're letting like, 10% run, 20% run, 15% run, whatever that number is. You're letting those runners run, but initially you're securing what you can secure in that range. Right now, study this, make it a habit. Whenever you're trying to analyze charts, make it a habit to plot out your zones and then measure the range. Is there enough range? And for the first few months, just sit and watch. Sit and watch to see how price moves between those zones. Thank you. What's up, everybody? So in this section, we're going to talk about fakeouts. Now, how do you define a fakeout? A fakeout is when price is consolidating and then instead of breaking to the top side, it does break up, or let's say if it's breaking to the downside and it does break down, it just goes to the opposite way from the bottom up, or it goes to the opposite way from top to the downside, right? That's basically a fake out. Now, when do fake outs happen? Why do they happen? Can you really spot them? Can you anticipate a fake out? The first things first, you cannot anticipate a fake out. It's really, really difficult to anticipate a fake out. That's like the same thing saying that, let's say you're playing soccer and you're like, okay, will this guy dodge me or will this guy fake me out? There's no way it's going to happen. You're never going to be able to fake that, anticipate that. Now, when do they happen? Fake outs normally happen after price is consolidating, right? So let's say you have a session. Let's say you have a pre-London session and you notice that price has been ranging during pre-New York, or let's say like, London Open and pre-New York, and now you're saying that, okay, like, you know what, we've been ranging since London Open and pre-New York, maybe we're gonna have volume at NY Open. And at NY Open, let's say at consolidation, price breaks down, and then price just goes the opposite way, right? That breakdown, that was the fake out, because price tried to move to the downside, but there was something there that made price come back in the range, and then price went the opposite way. That's a fake out. Fake outs happen all the time, right? So we need to understand this one more thing. Price will always move either up or it's going to move down. We as traders, we need to identify that what's the probability of price moving to the top side or price moving to the downside. Sometimes while price is consolidating, it's going to continue pushing bullish, and sometimes our price is ranging, it may continue to move bearish. So what we're going to do here now, we're going to pick up a few, they're basically just two variations of fake outs, right? There's a bullish fake out and there's a bearish fake out. So we're going to talk about those right now. All right. So first of all, we're going to talk about the bullish fake out, where price breaks to the top side, comes back in the range, and then starts going to the bottom side, right? So we have a resistance and we have some sort of a support down here. Right now, for example, we have a candle that's basically bullish at this point. We're bullish at this point, and you're like, okay, you know what? It's perfect. The next candle goes bullish, we break out of the range. Now we've broken out of the range. Now once we've broken out of the range, we're thinking that, okay, now let's say price has been consolidating for a little while over here. Once we've broken out of the range, we're thinking that, okay, now there's a higher probability for price to continue pushing up. Now either you're looking at an impulse entry or you're looking for a retest. So let's say, for example, for simplicity, we're looking for price to retest this broken resistance. So what's going to happen is that we may see another bullish candle go up, and after this we see a bearish candle start to push down in such a manner. Now when we see a bearish candle start to push down, we're like, okay, perfect, we've broken outside of the range. Now there's a high probability for us to create some sort of a support, and then you see another bearish candle that forms at this resistance. Now after this, you see that, okay, we have a bullish candle forming at this point. Now the fake out is going to happen when there's going to be volume in the market, right? So let's say, for example, this is pre-London, or this is, London Open, or pre-New York, New York Open, NYC, whatever type of volume there is, we've studied that. You're anticipating the next candle to either break this high, or you're trying to take a buy at this point for price to go up, right? So let's say you're actually taking a trade. Now, instead of moving up, what we see is that a candle forms and it closes back inside the range. Now when you have a candle closing back inside of the range, now this is going to be more prominent on a 30-minute time frame, not on the 15-minute time frame. 15-minute confirmations are weak confirmations. So I like to look at this on the 30-minute time frame, 1-hour time frame, 4-hour time frame. This also happens on a daily, weekly, stuff like that too. So let's say this is happening on the 30-minute time frame, right? You have a candle closing back in the range. Now this support, right, ideally becomes your resistance at this point. Now there are two variations this can happen at this point. Now if you're anticipating volume, there's a very, very high probability that the next candle can retest this area and then start to push down within this range. Now if you're going to trade this range, you need this range to be at least, I would say, 30 pips. This range has to be at least 30 pips for you to take this fake out trade. Now, this whole move to the top side, this is what we call a fake out, right? The reason why is that price tried to move up, right? Price broke out of consolidation. It tried to move bullish, but it closed back in the range. So when you have a prominent time frame, like a 30-minute time frame closing back in the range, after breaking out, there's a very high probability that it's going to continue pushing back down to the bottom of the range. And if there's more volume, we could also see price further dropping outside of this range and actually continuing to push down if there's more volume, right? So these things will happen. Now, the main thing to understand here is that price actually tried to break out of the range, right? This is very, very, very important. So whenever you're trading, you have to constantly talk to yourself. If you took a buy right here, right? Let's say that you took a buy right after you had a candle closing bullish, you took a buy, and like instead of price moving up, price went back in the range and closed bearish. Now your buy is nullified, right? You're getting out of that buy. You're no longer holding that buy because now you understand that, hey, maybe this move up was a fake out, right? Because now we have a candle closing back in the range, so I should better get out of that buy. And as you move along the market fluidity concepts, you start to become fluid enough to understand that, okay, maybe we're not continuing to move up, so maybe the dynamics of the direction of the market has changed. Right? It's very important for you to read the candles, right? So when price comes back in the range, this is where you're saying, okay, like, you know what? We've closed back in the range. If the next candle breaks this low, this is more discussed in the impulse entries. If the next candle breaks below this low and we have a 30 pip range, I think there's a very high probability for price to continue pushing down in the range, right? So remember I talked about there's going to be two variations. This was the first variation. Now we're going to talk about the second one. It's very important we 100% totally understand how price is moving, how price is acting for us to really take advantage of these, fake outs. Now, for example, instead of price closing like this, we have a bigger candle that closes in the range. Right? Now what's going to happen? Once we have a bigger candle closing back in the range, if you're looking for an impulse entry right here, what we talked about in ranges, in way to take a trade, whether at support or resistance, we understood that if you're trying to take a trade right here, as the next candle wicks up and starts to break the previous candle's low, is this a good entry right here? Is this a good entry in the middle of a range? Absolutely not. This is the worst possible entry you can take because essentially you're taking a sell while price is in the middle of a range. So even though if this is a 30 pip range, your tradable range is maybe like 10, 15 pips. What are you going to do with this, right? You can't do anything with this, right? Because your range is essentially smaller now. 30, let's say like 15, 10 pips, like if you factor in the spread as well, right? So it's not enough. So at this point, what's going to be much better for you to look for is for a possible retest and then a continuation down. Because if this is a 30-minute time frame, we already tried breaking up, right? Did that work? No, it didn't work, right? So there's an 80% probability now we will continue pushing down to the bottom of the range. Now, also remember, there's a low probability that price may continue pushing up. Right? We have to keep that in mind. It's not all the time the price will continue pushing down because we always talk about in probabilities. There's a very high probability we may continue pushing down. Like a lot of traders have traded these fake outs, they've been successful at it, but also there's a small possibility you have to understand that price may start to continue pushing up. Right? And also remember, one very important step. If you're trying to trade this fake out, right, and only trade and execute on the fake out if you did not execute on the buys. Now, how would you know this is a fake out? You wouldn't know. The only way you're going to trade on the fake out is that if you have missed your execution on the buy, right? For new traders, if you executed on the buy and price comes down and you know that this is a fake out and you studied in Smart Roger concepts that this may be a fake out, Don't execute on it. Just watch it play out, right? You watching how price moves, that's going to be your biggest development as a trader. 100%. Right? So always understand there has to be range for you to take a trade, right? And this candle closing down here, you have to wait for a retest. If the candle, let's say the candle closes back in the range like this now gives you enough range to take a trade. Right? It gives you enough range to take a trade. And if this is a 30-minute time frame, there's a very high probability it's going to work out. Right? So this is very important. Look at these examples in the charts. In the past, you will see that there's a very high probability price has moved in the opposite direction. Now, a lot of you people may know some stuff, but going over these basics, it's going to rekindle something. It's going to light up that spark or light up that bulb in your mind, and you're going to say, oh, you know what? This is something I missed, or this is something I didn't factor in while trying to trade fakeouts. Now, we're going to talk about the bearish fake out in this scenario. Now, it's also true for the opposite. Let's say we have a resistance up over here and we have a support down at this point. Now, let's say, for example, we have, bearish candles that start to break down all the way from the top hand side. We're starting to break down on the bearish candles. Now, if we're starting to break down the support and you see, okay, like, you know what, there's a probability for price to go down. And now what we see in this bearish fake out is that we have a retest and candles start to print down. Instead of continuing to the bearish side, we see sometimes, a candle that forms like this, a rejection at this point. So whenever we see a rejection below a support, or let's say price started to move down and now we see some sort of rejection, there's a probability that price may do a retest at this point and then continue on pushing down. But instead, what happens is that you have a candle that instead of going down, we close back up in the range. Now, this is the opposite of what happened in the bullish fake out, right? In this bearish fake out, there was so much volume that price broke below support, right? We closed below support and we had confirmations that now we may have a retest to continue down, but instead of a retest, price closes back in the range, right? So whenever we're closing back in the range, and we do understand that this may be a 30 pip range or even like a 40 pip range based on a 15-minute time frame or 30-minute time, especially on a 30-minute time frame to a 1 hour time frame. If this is a 30 to 40 pip range, this is a perfect opportunity for price to continue pushing to the opposite direction. Because again, price tried to break down, it couldn't maintain its bearish move, so it closed back in the range. Now visually, what we're anticipating is for the next candle to wick down and continue pushing up in this range. Right? This is the most simplistic form of a bearish fake out. Like whenever you have a bearish fake out, there's a very high probability price may push in the opposite direction. And as we continue up towards the resistance area, there's another very high probability that with volume, we can continue breaking up. And this is where the trend can continue to push up. Now, another scenario in this, which happens a lot of times, is basically, let's say that we have a candle that closes within the range, right? It closes somewhere in the middle of a range. Now, whenever a candle is closing in the middle of a range, this is not the right time to probably take a trade at this point because we're closing in the middle of a range. What are you going to do in the middle of a range, right? You have to identify what probability there is for price to move up and what probability there is for price to move down. There's a 50-50 probability that price will either move up or it's going to move down. And as we've discussed in the previous lessons, that whenever you're trying to take a trade, make sure your entries are taken near to the zones, right? So in this case, there's probably, if we're following perfect price action, perfect market structure, there has to be some sort of a bearish move down. We create some sort of a support. And if there's volume, we may continue to push up. Right? But this is not the ideal state to take a buy in a bearish fake out. Because essentially what's happening is now your probability of price moving up comes down from 70% or 80% to maybe 60%. right? Because if this is a 30-minute time frame, we've created a resistance at this point, right? So this is where complications happen. So whenever you're seeing a setup form, let's say a fake out setup, for me personally, I want to see something perfect formed, right? And these things also do happen. Something perfect is going to be something like this. That's it. That's all what I want to see. Because if I'm trying to take a trade at this point, on the next candle right here, my stops are below the 30-minute candle, and then I'm not expecting this new candle to break the low of the previous candle. I'm just expecting it to continue to push up. That's all what I'm expecting it to, right? Now, when it comes towards managing risk, we have to go over the risk management section. We manage risk on the 15-minute time frame, you know, when we're taking on 30-minute candle trade, and so on and so forth, right? So fake outs, they do happen. We have to see if the candle confirmations are there. And we've talked about this a lot of times too. Make sure that the trade you're executing on, or the candle setup you're executing on, is exactly how you picture in your mind. Because most of the times, those are the cases that do work out. All right, as simple as it sounds, it's actually that simple. The only problem is we have to just wait. We have to wait for candles to print something that we can recognize. When we can recognize the pattern, when we can recognize a certain pattern or a certain way the candle is closing for us to actually execute on a trade, then executing on that trade becomes much more easier, because we know in our mind that we've seen certain things happen over and over and over again, and also there's a higher probability for certain things to play out. But at the same time, we have to understand probabilities as well, right? Now these setups, like these setups we talked about, there's a higher probability for them to play out. There's also a lower probability they may not play out. So that's where your psychology comes into play, and we've discussed this all over again as well, that whenever you have that lower probability playing out, you have to manage risk. That's a part of trading, that's a part of your trading plan, that's a part of your risk management strategy. So whenever you're fronted with a situation where that small probability of a trade not playing out, that's when you got to mitigate risk, right? But in the higher probability, like 70% chance, 80% chance, things are playing out, and you do see fake outs happen, that's when you're going to say, okay, you know what? We're going to continue with this and we're going to execute on this. Again, fake outs, they're complicated, right? They're complicated. You can't anticipate a fake out until and unless a candle really closes in that direction, right? So in the start, what I'm going to say is just like sit back and watch on the charts how fake outs have played out. If you were able to recognize them, if you were able to anticipate them as candles close back in the range, right? Go over the previous charts, go over the 30-minute charts, 1-hour charts, and look at times of volume. Look at times when price was ranging, and during the time when price was ranging, look to see whether there was a fake out. If there was a fake out, look at the candles and really ask yourself that where could you have executed a profitable trade. Now, you're not going to get better in a week or in a month. This would take like 3-4 months of deliberate effort and deliberate practice in seeing the same things happen over and over again. Awesome. That's all for fake outs. We're going to see you in the next section. Now, this may seem very simple. Buy support, sell resistances, right? Very simple idea, but you have to understand, when are you actually trying to buy supports? When are you actually trying to buy resistances? So we're going to talk about two things. We're going to talk about trend trading, right? Trend trading, and we're going to talk about counter trend trading, and these two concepts are equally as important. So first, we're going to go over what's the trend, how you're trying to gauge market structure, how you're trying to gauge candles movements, and then we're going to talk about counter trends, because a lot of times what happens is, like, for example, price starts to rally and price is rallying, amazing, perfect. What traders like to do is they're like, okay, you know what, price is rallying, and I see a resistance to the left-hand side, and because of that resistance, we will reject that area, and then you take a sell. So when you take a sell, essentially what's happening is you're trying to take the opposite trade of a price that's moving up. Or if price is moving down, like we say, falling knives, if price is moving down, you're like, okay, you know what, I see a support. And based on what I've studied is that we're reaching a support, there's no confirmation for buys, but I see a support, and I'm going to take a buy right there. And when you take a buy right there, or you take a sell all the way up over here, price starts to rally up. Or if you take a buy, price starts to keep on dropping down. And this used to happen to me as well, because we're trying to counter trend. We're trying to catch that wick trade. We're trying to catch that perfect entry to have a winning trade. So we're going to go over that. First, we're going to go over trend trading. Next, we're going to go over counter trend trading. The concept is very similar, very simple. This is why it's smart Raja concepts, very simple concepts. But the only issue is you have to wait for the candles to print the way you should have them printed, right? So let's talk about that. All right. So what's the basics of a trend? Now, a lot of people know this as well. A lot of people have even studied this through our live streams, to our videos on YouTube, stuff like that. But it's always a good idea to go over the basic concepts, because the basic concepts are something that build your foundation, and a strong foundation is what you need to be profitable in the markets. Because guess what? Markets are not complicated. Markets are just as complicated as you're going to make them. So we're going to go over that right now. So the basics of a trend is this: price moves up, we create a high, price comes down, we make a higher high, price comes down, we make a higher high, and so on and so forth, right? That's how price moves. Now, when we're taking a look at this from a candle's perspective, right? What happens? You have a candle that prints bullish. Now you want the next candle to move up. Next candle should respect the low of the previous candle right over here. So now we have a higher low and we have a higher high. Now the next candle has to respect the low of the previous candle and continue to push up. So this is the basic idea of price moving up, making higher lows and higher highs based only on candles. Now, we're going to go into trend trading. If I can find my magic eraser right here. Okay, found it. Awesome. Now, trend trading is really simple. You identify the trend, and the way you identify the trend is basically you see where the higher time frames are moving. Now, let's say, for example, you're looking at the daily time frame, and the daily candle, you see that, we're pushing up over here. You're like, okay, you know what? Daily candle has to move up. You look at the 4-hour candle, and, maybe the 4-hour candle is, somewhere situated like this. We have a candle like this. We have a 4-hour candle forming like this. And you have clean range to the left-hand side. And you're saying, okay, you know what? The 4-hour candle is also bullish because we're creating support. Okay? Now, the basic idea of trading a bullish trend is that you're waiting for price to create support. Make a note of that. To trade a bullish trend, you have to wait for price to create support. That support could be on the 4-hour time frame. That support could be on the 1-hour time frame, 30-minute time frame, 15-minute time frame supports. They are okay, but the problem with the 15-minute support is that the confirmation is weak. It's a weaker confirmation. So that's why we're looking at the, I would say ideally, the 30-minute time frame or the 1-hour time frame, right? So you have to look for supports on the 30-minute and a 1-hour time frame. Now, let's say that we are in a bullish trend, right? So we're going to remove this and we're going to draw up some proper examples right here. But this trend is also identified on the daily and the 4-hour. So if you have made up your mind that the 4-hour is bullish and there's a high probability 4-hour can move bullish, you have to wait for supports. The supports are formed on the 1-hour and 30 minutes. So let's say, for example, let's say, for example, we have a bullish candle moving up. This is a 30-minute time frame, moving up, moving up, moving up. We are moving up right here, okay? Awesome, we moved up at this point. Now, we have formed a resistance at a zone on the 30-minute time frame. Now, if you've gone through the section of zones and ranges, you may look at this and say, okay, you know what, Raja, based on that virtual class we did, price is at a 30-minute zone, and 30-minute zone is a very strong zone, so there's a high probability it can go down. Why can't we take sells? The reason why you can't take sells at this point is because, let's say you take sells at this point in a heavy bullish trend, and you have pre-London volume, London open volume, New York open, NYC, whatever that is, but the time is when there's a lot of volume, right? So let's say you take a sell. What can happen is, if you're not focused on the trend, is that the next candle can break this high right here and continue pushing up. That's something that can happen. So whenever you have a bullish trend, you're not looking for sells. No, you're looking for buys at this point. And we're going to talk about the condition for sells as well in a bullish trend. So let's say you have a rejection right here at this point, and now price starts to go down. We're moving further down. We're moving further down right here. we're moving down here, and let's suppose the trend is coming all the way from the bottom, and now you have a support form, right? This is a support form. A support is formed when you have a bullish candle closing after a bearish candle, right? The only forms of supports you're looking at are in uptrends. Always remember this all the time. Trend is your friend. Don't trade in consolidation unless you have a bigger range, right? And when in a trend, wait for supports formed. These supports could be in the, these supports could be a part of your 30-minute time frame, your 1 hour time frame, right? The higher the time frame, the better. But the 30-minute time frame, strong supports. Now, first things first, right? Your support is formed. You waited for the support formed in an uptrend. Perfect. You got your support formed. Now, at this point, you're measuring the range, right? Let's say this range on the 30-minute is about 30 pips. You got a 30 pip range. You got a support formed, and you're like, okay, you know what? I have enough range to take a trade for price to retest this high. Now remember this one thing. Whenever we're in a trend, whenever price is in a trending market and it makes a high, there's a high probability, there's an 80% probability that that high is going to be retested. And how is that high going to be retested? If we're going to create support. So if we're creating support at this point, there's a high probability for price to continue pushing up if we're creating a support, right? And your stop is below this candle. That's it. That's all what you're looking at. It's a perfect example. This happens all the time. All the time it happens like, clockwork when there's times of volume. So whenever you have an uptrend and you're anticipating 4-hour candles to go bullish, you're anticipating the daily candles to go bullish, you're waiting for 30-minute or 1 hour to create support and to continue pushing in the trend direction. That's where you're only trading the bullish trend. Now, sometimes you can have different variations, and these variations could be like, you can have a bearish candle forming like this, and you can say that, okay, we got a bearish candle closing with a small body. This means that maybe the move pushing down, the volume of bearish candles moving down is decreasing because now you have a smaller body. Because always remember, the candle bodies are going to tell you how much volume there is in the market, right? So you have a bigger body, boom, you got a small body at this point. What are you trying to do at this point? Are you trying to wait for a support formed, or are you trying to take an impulse entry as the next candle breaks above this high without breaking this low? You're taking an impulse entry at that point, right? Because sometimes, if you're new, you're going to say, okay, I'm going to wait for the support form, and you're going to wait, and as you're waiting, candle starts to pump up at this point, and candle closes like this. And now you're like, oh man, I knew price was going to go up. How did these people take impulse entries? I don't understand this. So the more you see price move up without you being not in the trade, the more you're going to learn about impulse entries, because the more you're going to see, because when I first started about impulse entries, I would see price move against me all the time. And I would say, okay, why is price moving against me? And I'm not in that trade. How could I have been in that trade? So I'm like, okay, if trend is where price, makes a higher high and a higher low and all that stuff, and if this candle is respecting this previous candle's low, which means it's making a higher low, and if it's breaking above this high right here, this means that it's making a higher high. So if I can take an entry as it's breaking the high and have my stop below this candle or even this candle, maybe, and if the trend is up and there's volume, maybe I have a higher probability of winning that trade with an impulse entry. Make sense? So that's how this whole impulse entry thing came into being, by watching price move when you're not in that trade, right? So go over these things, right? Go over this virtual class again. Now, let's say we have created a support, right? So we're going to talk about this. So let's say we've created a support right here. Let's say we've created a support right here. Now we have a support at this point. Now, okay, let me just bring this up here a little bit.
Hey everyone, just a quick moment. Below is the QR code for my Discord server. Feel free to join. You can also add me directly on Discord at lgamer69. For more exclusive content that can't be uploaded on YouTube, check out my Patreon here, patreon.com/legendarygamerscyberzone.
And we're going to talk about counter trend trade when price is trending bullish. All right. So let's say that price is, when the trend is bullish. Okay, my bad. Let's do this, right? So from down over here, price is moving up, price is moving up, price moves up, and then boom, we have a resistance formed, and we have another resistance formed right here, bearish candle, more bearish candles coming down, like this, right? Awesome. Now, all of a sudden, we have a support formed right here. Now, if you're trying to take sells in a bullish trend, again, you have to wait for support formed, right? Now we have a support form at this point. Now, if we think that the price can go down, you have to wait for price to break support, right? In essence, you have to wait to see whether you can get a bearish candle forming like this, closing below the support, because one candle closing bullish after bearish candle, boom, you got support form. Now, if you want price to go down, you have to wait for a candle to close below support in a bearish form, and now you can anticipate the next candle to continue pushing down like this. And in this case, we're going to wait for, an impulse entry to break this low and go down, because now we're going to say that, okay, even though the trend was bullish, we created support, and support meant that price would go up. But if the next candle didn't break the high right here, and it broke the low, closed below, maybe we can be fluid in the markets. That's what market fluidity is, right? Maybe we can be fluid in the markets, and we can identify that, okay, maybe we're not trying to go up now because now we've broken support. Maybe there's a high probability for price to go down. Okay, the more you see this happen, the better you're going to get at it. This is a perfect world example. There are also variations of these, right? There are a lot of variations of these. The candles can close with small bodies. The candles can close with, big bodies and stuff like that. So let's say you got a support right here, and you got a bearish candle that's closing like this, and then you can get another bearish candle that, closes like this. So then you can anticipate price to go down. And as we talked about impulse entries, you can go over that, and zones and ranges, that if let's say this candle closes away from the support, what are you going to do? Are you going to take a sell, or are you going to wait for price to retrace? Because the further away we move from a zone, what happens? The further away we move from a zone, the higher the probability of price to retrace, to retest that zone, right? So you have to wait for price to print in a way that you can understand. So if we're closing like this, then you're like, okay, you know what? There's a high probability that price can go down. And always remember, there's a lower probability we can go right back up, So you're always trying to trade when there's a higher probability, for price to continue moving. Now, this was for uptrends. Now, obviously for downtrends, it's the opposite. So we're going to go over that now. So let's say, for example, you have candles pushing down. You got a bearish candle, you got another bearish candle right here, and then you have another bearish candle. People love when price moves down, right? We love when price moves down. And then we have another bearish candle starts to move down. Beautiful. We have a nice trend going on over here. 4 hour expecting to go down. Daily is expecting to go down. You're like, awesome, perfect. This works amazing. Now all of a sudden, you have a bullish candle forming right here. Boom. We got support formed. In a downtrend, okay? Don't forget, this is a DT, downtrend. This is a downtrend. Now, whenever you have a downtrend, and if you're trying to take a buy at this point right here, and it's a very, very volatile pair, let's say it's gold or pound yen or whatever high volatile pair you trade, and it's a downtrend, there's a possibility that if you take a buy right here, the next candle respecting this high, it can continue pushing down. You got to keep that in mind. So whenever you're trading the trend, don't fight the trend. Wait for the trend to show you some signs, right? Because having good signs is a good form of trading. So now let's say you got a support formed, next candle starts to move up, next candle starts to move up, and then we have, boom, we have a resistance form right over here. This is a 30-minute resistance. this is a 15-minute maybe, but I would say a 30-minute or a 1-hour resistance. We've gone over these situations over and over and over and over again, right? Now you have a resistance formed, there's a high probability for price to go down. Now another thing, you have to make sure that this is a tradable range. I would say like minimum 30 pip range. If this is a tradable range, you can have an easier move going down. Because whenever price makes a low, there's an 80% chance that price will retest that low. You have to wait. Whenever you have a downtrend, don't fight the trend. Don't take a buy. Wait for price to create resistance and then continue down. Now, sometimes what can even happen is that without price retracing all this way up, what can happen is that you can have, let's say, a bullish candle form, and then you can have a bearish candle form like this, right? Now what do you have? Boom, you have a resistance formed. Now is this enough range? Well, candles with no wicks, what wicks, we already talked about that. Now, is this enough range? Do you have enough range to take a sell? Absolutely not. Now price is just consolidating. Same thing goes for when price is trending bullish, and retraces and whatever. Bullish, retraces, create support. Yeah, right? The same thing. So at this point right here, there's no sells at this point, right? The only thing that you can do is that if a next candle, let's say we break above this resistance right here, we've broken above resistance on a 30-minute time frame, so that means we've broken above a strong zone because 30-minute zone are stronger. Now you can anticipate the next candle to correct the move that we had earlier on, which came down. So that's clean traffic to the left-hand side. Makes sense? Now this is where you can take a counter trend trade. In the same scenario, okay, now follow me right here. In the same scenario, let's say that this candle closed away from a zone. Let's remove this arrow. Let's say that this candle closed away from a zone. Can you take a buy at this point in downtrend? Absolutely not. Because we moved away from the zone. There's a high probability for it to do a retest and then potentially go up or come down, and this whole thing becomes a fake out. We've talked about fake outs as well. So whenever you're trading, you have to wait, or let's say whenever you're trading a downtrend, you have to wait for a candle to create some sort of a resistance. Now this resistance can form with a bigger range or small range. If it forms a small range, this is maybe what, like 10 pips? What are you going to do with 10 pips? Nothing. Then it's better off to wait for price to break support or close below or give you some more confirmations that we can continue to push down. But again, if you're trading counter trend in a downtrend, you have to wait for price to break resistance. No, form resistance first and then break resistance. So if we break above this area, then you can say, okay, you know what, maybe now we can correct that move. Okay? Now we have to go over this again. Go over this class again, this virtual class. These are very basic concepts. These situations do occur in the markets, and the more you familiarize yourself with these concepts, only in times of volume, they will play out in your favor more often than they're not going to play out in your favor. All right, so trend trading, as simple as it may seem, it really is that simple. But the main idea is you have to wait for candles to print in a way that you can recognize for you to take a trade. So we're going to go over that again. If you're trading an uptrend, you have to wait for support to form. If you have a support form, then you can take a look at how the support is formed. Has the candle closed, a big body candle, small body candle, a bearish or bullish, whatever that is, but the support is formed. If you're trying to sell in a downtrend, you have to wait for support form, and then you have to wait for support to break with confirmation. Same thing goes for downtrends. If you're trading downtrends, you have to wait for a resistance to form, right? If you formed a resistance, then you have to wait to see if you have any, candle confirmations, candle closing bearish for you to take a sell. And if you really want to sell, or if you really want to buy in a counter trend when it's moving down, you have to wait for resistance to break. Right? The only way you're waiting for a resistance to break is in a downtrend to maybe correct that move up. Or the only way that you're waiting for support to break is in an uptrend to correct that move down. Right? Important concept. Go over this virtual class again, maybe 3 or 4 times. Some of you may already know these things, but it's always a good idea to go over these simple concepts, because sometimes we miss certain things. Sometimes we ignore certain things, and like that one quick thing can light up a bulb in our head, and I'm like, oh yeah, you know what? That actually made sense. That really did make sense. So good luck. Look for these situations in the charts only in times of volume. You got your pre-London, London Open, pre-New York, New York Open. Well, pre-New York volume has shifted a little bit, so NYSE, London close. Good luck. What's up, everyone? Welcome to another episode of Smart Raja Concepts. Now, today we're going to talk about impulse entries. Now, before we get into the impulse entries and the candle confirmations and all that stuff, let me talk to you about how basically this whole idea of impulse entries came in, right? So now, in the beginning, we're basically told that you have to wait for candles to close, you have to wait for candle confirmations, whether it's outside of a zone or when it's creating a support, you have to wait for a candle to close. Once the candle closes, that's your confirmation. Then take a buy or take a sell, and price is most likely to go up or most likely to go down. We all know there are probabilities, right? There's a probability price is going to move up. There's a probability price is going to move down. Now, when we're looking at these things, right? When we're waiting for candles to close, whether bullish or bearish, sometimes price doesn't really give us that confirmation. Sometimes, price just continues rallying up or it continues dropping down. That happens a lot of times, and as a new trader, when we look at that, we think, oh, okay, maybe I'm missing the move right here. Maybe, maybe my strategy is wrong, or maybe I haven't aligned myself properly with the market because I was told to wait for the candle to close. And as I'm waiting for the candle to close, price is just moving where I wanted it to go. Man, I've missed the trade. Now, that used to happen to me a lot. And what I decided to do at that point was I was like, okay, that's interesting because I'm really good at executing when candles are closing. I'm really good at executing, especially with confidence as candle is closing. But what am I going to do when candle just continues moving my way? Because someone's taking that trade. Someone is in that trade profiting as price is moving, right? Whether that may be a entry before price moved, or maybe that was an entry that someone was, like, okay, you know what, I think price is going to go up and I'm just going to take a buy, and price goes up and price goes in their favor, and they're like, okay, you know what, yeah, I knew price was going to go up. But as traders, we need to execute with confirmations, right? So then I started to do was I was like, okay, you know what, if price goes in my favor without candle closing, how could I have executed on this trade? Now, sometimes, we can use a buy stop or a sell stop. Well, buy stops and sell stops basically mean is that once your buy stop is executed, you're anticipating price to continue moving bullish. If your sell stop is executed, you're anticipating price to continue moving bearish. Now, when impulse entries came in, so you have to look at where price is breaking the highs or the lows, because I decided that, okay, you know what, if I'm missing out a trade and price continues moving, where could I have an entry? And I spent almost 5 to 6 months just watching, not trading, just watching. I spent 5 to 6 months just watching to see how could I have executed on that trade. And then there were like almost certain, very few scenarios that made sense. That, okay, maybe this is what we can do. So we're going to talk about, first we're going to talk about candles. We're going to talk about candles, the way the candles are closing and forming, types of candles. And then we're going to move into these certain scenarios that have personally worked best for me. And a lot of you guys, you've been through the market fluidity. We have 3 webinars on impulse entry in market fluidity. Impulse entry is 1.0, 2.0, and 3.0. You guys know that, right? But today, we're going to talk about specific scenarios that have a higher probability for price to continue where we expect it to go. So we're going to talk about that. Now, first, we need to talk about types of candles and how the candles close. Some of you may already know this, but we're going to talk about the candles once again, the whole thing, how candles close, how candles open, what they mean with wicks and without wicks. So let's take a look at this right here together. So here we have a bullish candle with no wick on the top, but it has a wick at the bottom. Next, we have a bullish candle with no wick at the bottom, but it has a wick on the top. Now, what does this mean? Usually when you have a bullish candle with no wick on the top, this means that there's no range for the next candle to go up. That's what that means. But when you have a candle with no wick at the bottom, this means that the candle closed bullish, but it had no volume to go down. It had no opportunity to even create a bearish wick. The volume was so much bullish that it couldn't even go down. It just moved up and it created a wick on the top, right? That's what this means. This right here, the candle volume was bullish, obviously. It went up, but it has no wick on the top, which means there's no range for price to continue moving up. That's what this means. Now, if we look at this from a bearish perspective, let's say now we have a bearish candle. Now the things have turned, right? Now when we take a look at the first bearish candle, the first bearish candle means that there was no bullish volume. There was zero bullish volume. The price couldn't even make a top wick, and price came down, made a lower wick at this point. Next one, we have a bearish candle, but no wick at the bottom. This also means that there was a lot of volume for price to go down, but it didn't make a range. If it didn't make a range to the downside of a bearish candle, this means there's a 50-50 probability that price is gonna continue pushing down, right? Get it? We talked about the bearish candles, and we talked about the bullish candles, candles having no wick on the top and candle having a wick on the top and the bottom at the same time. So now we're going to talk about the scenario that I execute on and a lot of other successful traders have executed on to make profound gains from the market, right? So now let's talk about that. For example, we have a bullish candle that goes up. Let's say we have an uptrend. We have another bullish candle that goes up. We have an uptrend. And then we have a bearish candle that closes like this with a big wick at the bottom, right? This normally means that price tried to go down, but it couldn't maintain its volume down. It closed a small bearish candle. This is what this means. Whenever we have a structure like this, there's a very high probability, provided there's volume in the market, that could be in your pre-London, London Open, pre-New York, New York Open, London close. Whenever there's volume in the market, there's a very high probability that price will break the high to continue pushing up. Right? Now, there are two scenarios in this situation, right? The first scenario, we're going to talk about the first one. The first scenario is that when the new candle starts, right, and it starts to break the high of this bearish candle, once it starts to break the high right here, there's a very high probability it's going to continue pushing up, right? Now, in this case, your stop losses are going to be below the previous candle wick. And I'm going to tell you why. The reason why your stop loss is going to be below this previous candle is because this candle didn't make a lower wick to continue moving up. It didn't make a lower wick to continue to move up. So whenever you're taking an impulse entry with a candle that hasn't made a lower wick, there's a higher probability it can continue pushing back down, right? It has a higher probability it can retrace and come down. So this is risky at this point. So when we talk about, okay, what's the probability of this candle continuing up versus you have a candle that made a lower wick first before going up. The candle that made a lower wick first has a higher probability it's going to continue moving to the top side. But if you have a candle that did not make a lower wick and start to go up, that has a lower probability to go up. It can still go up, but the probability of going up is a little bit lower. So when I take a look at a pattern like this, or when I take a look at, if the candles are closing in this way, when you have a bearish candle, I look at the wick to the bottom as having, let's say, a 90% chance that price is going to continue to push up. But if I see that a candle has no wick at the bottom, and it starts to break this high right here, I see that as maybe like a 70% chance that price is going to continue to push up. You see what I'm saying? So whenever you have a candle with a lower wick first, as it starts to break the high, I'm using my regular lot size. But if there's no lower wick, I'm using a smaller risk, a smaller lot size because of the probability that it's going to go up, right? So you're keeping in mind the probability, you're keeping in mind the risk that, okay, what's the probability it's going to go up? And if there's a high probability, you're using your regular risk. If there's a lower probability, you're using a lower risk at that point. Now, let's talk about how are you anticipating the candles to form. Now, the basics of trends is that price, like, let's say you have a candle, and trend is going bullish. You have a next candle, trend is going bullish. So a normal trend is that a candle is going to respect the low and it's going to break the high. So it's going to make a higher high and it's going to make a higher low, right? Very simple. That's the basics of a trend. So let's say if we are expecting price in this example to continue to push up. And let's say we have the perfect scenario, and trust me, man, these perfect scenarios, they always happen, they do happen, and people execute on these. Now, the perfect scenario is whenever you have a candle forming, even though this candle starts to go up, it shouldn't break the high of the previous candle. If it doesn't break the high of the previous candle, and it starts to make a lower wick respecting this low, and once it starts to break the high of this bearish candle, then you can say, okay, you know what? This is a very high probability that price can continue to push up. Because number one, trend is bullish, right? Number two reason is because the previous candle is an exhaustion candle. An exhaustion candle is when the wick is bigger than the body. It's an exhaustion candle. And number three is that when the candle, new one, is breaking the high. Once it's breaking the high, you're like, okay, you know what? This is perfect. All what I'm going to do is I'm going to take a sell impulse entry and my stops are going to be below this current candle. And then price is going to continue pushing up. There's a 90% probability that this will continue to move up. I've executed on this a lot of times. Every time this happens, I'm like, okay, you know what? This is a higher probability for price to move, and let's execute on this. Now, second, right? Second is basically the opposite. Let's say you have a bearish candle coming down, you have another bearish candle that comes down, so we're making lower lows and lower highs, and then all of a sudden you have a candle that closes bullish like this. Now essentially we've created a support in the scenario where a candle has closed bullish, and you're like, okay, you know what, we've created a support, and maybe, one thing I forgot to mention, these scenarios, they perfectly work on the 30-minute to 15-minute time frames, right? Also, they work on the 1-hour time frame. They also work on the 4-hour time frame. But as you go higher up in time frames, what you're going to realize is that the stop losses are going to get bigger, but the moves are also going to be bigger, right? It's more prominent on the 30-minute. I've executed a lot of times on the 30-minute, very, very prominent. I've executed on the 1-hour time frames as well, very, very prominent. Now, let's say you have a situation like this, right? You have a potential support formed, and let's say this is a 30-minute time frame, excuse the writing, 30-minute time frame, and you have a candle closing like this. Now, normally, when I look at this, I'm thinking about that, okay, you know what? As long as the new candle respects this high at this point, and once it breaks this low, okay. Now, back to business, right? So now let's say if the new candle, it respects this high, but once it starts to break this low, this is going to be the perfect confirmation for price to continue pushing down, right? And in this scenario, it's going to be the same exact thing. Now, what you want the new candle to move up, but to respect this high. And as it starts to break the low of the previous candle, which is a bullish candle, this means the trend is being respected because we're making a lower high and we have an opportunity for price to create a lower low, right? So when it starts to break the low, this goes in a sell mode, and then price continues to push down. This is the perfect opportunity for an impulse entry in this scenario as well. Now, important thing, when are we expecting this to happen? Normally, whenever you have a scenario like this of an impulse entry, normally with a higher probability, you're looking at the second half of the candle to break this low. Second half of the candle. Sometimes the first half of the candle also works. So let's say if you're looking at, let's say this is a 30-minute time frame, maybe in the second 15-minute candle starts to break this low. Right? So now I want you guys to follow me here, right? I want you guys to really follow me here and really understand. Because let's say the next candle, it starts to make a top wick. This means that maybe the first 15-minute candle of this 30-minute time frame starts to make the top wick, or maybe it closes bullish, or maybe starts to go up. But as long as this high is respected and the second 15-minute candle high respected and the second 15-minute candle of the 30-minute starts to break the low, then you're like, okay, you know what? There's a high probability to continue down, because maybe that second half of the 30-minute may push the entire 30-minute candle all the way down, right? Or all the way bullish if we're looking at from a bullish perspective. This is the scenario that have worked over and over and over and over again. But the trick is to actually wait for this candle to form. The trick is to wait to see if the candle is really forming like, once the candle forms like this, the next waiting situation is that you have to wait for the next candle to break the low at this point. This is something that has worked. Now, we're going to talk about another scenario, and that scenario is going to be a little bit more risky. It's risky in terms of, because the trend is already bearish and the trend is already bullish, and you're really trying to catch that wave, right? What it looks like is like this. Let's say you have a bullish candle formed like this, and you have another bullish candle formed like this, and for example, we have a resistance at this point, and now all of a sudden, we have something bearish form, candle forming bearish, and then we're also forming another, some sort of a confusing candle, and then we have a candle that's starting to break the high of this previous candle. Now, this is where some risk comes in. For this opportunity to continue pushing up based on an impulse entry, it has a lower probability than the examples we talked about earlier. Okay? We have to understand this. This has a lower probability. Even though you want to say that, so now this is where a lot of moves are missed, right? A lot of times you're waiting for the candle to close because, that's the safest way. But essentially what you see that candle starts to move up, and it just continues to move up. And when it continues to move up, you're like, oh man, why didn't I enter an impulse entry? It would have been so perfect. Now I've missed this entire move. It has gone up. There's no way to get this back, and yada, 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 yada. That's very normal. That happens, right? So now if you're somebody who gets stuck in these and you're not focusing on impulse entries, you're not trying to learn them, you're not trying to anticipate them, but you're missing trades, that's perfect. Because once the candle starts to break these highs here and here, you're looking at this and saying that, okay, you know what? If we broke above these highs, maybe, just maybe, I could have had an entry right over here as it broke this high right here. And my stop loss could have been below this candle. Because if we're breaking above this high, right, we're making a higher high at this point. There's a very high probability we're making a higher high. And at the same time, if we're making a higher high, then there's a higher probability we're also making a lower high, like a higher low at this point. Now, when does normally this happens? Normally this happens in high volume times, right? High volume times, market opens, market closes, we have news, we have breaking news on gold. We saw earlier on that price went up on gold about $30. 300 pips gold went up yesterday. This was the 7th November So this may be recorded late. Anyway, whatever, right? So this is where you're trying to just watch to see where you could have entered. Now, again, as I said, this is riskier than the previous ones. This is way riskier. And I'm going to tell you the risk associated with this, right? Now, I know some people also have some questions, so we're going to go over those questions as well. Now, the risk associated with this is that even though if it's moving up, even though if it's breaking the highs right here, there's a very high probability it can just continue to fall back in this range, right? And this move up just becomes a candle that made a wick to the top hand side. That's the risk associated with this. So if you're someone who's willing to execute on something like this, you have to keep this risk in mind. If I'm going to execute on something like this, or if I'm going to execute on an opportunity which is presenting itself like this as it's breaking the high, and I'm trying to take a buy at this point, I'm keeping in mind that it can continue back in the range. So if the probability of it moving up higher is lower than the example we talked about in the beginning, I'm not using my full risk. I'm using half risk, or I'm using 3/4 risk, but I'm never using my full risk at this point. Never. At the same time, a more risky situation in this case could also be when you have a candle that just moves up without making a lower wick. A candle moves up without making a lower wick. That is extremely risky, because a regular anatomy of a candle is that a bullish candle is going to look like this. It's going to have a wick at the bottom. It's going to have a wick at the top. This is like something like a human with 2 arms and 2 legs. If a human has 1 arm and 2 legs, or like 1 leg and 2 arms, or no arms and no legs at all, then you're looking like, that's abnormal. That's, that's a bad example, but still, you know what I'm saying. So a candle here, if it has no wick at the bottom and it starts to push up here with volume, there's a chance that it can just continue to push down to probably make a lower wick. Who knows? It can continue to move down to make a lower wick. We don't know that. So once a candle moves up with no lower wick in the beginning, I'm staying out of it. I'm staying out of it because I want nothing to do with that. That's risky. That's not according to my plan. I'm not doing anything with that. Now, normally, what I would wait for, let's say you have a candle that closes bullish, right? Now, the size of this candle matters. The size of this candle matters. Let's say the size of this candle is, I'd say like 15 pips, right? Let's say the size of this candle is 15 pips. Then I'm going to be waiting for the next candle to probably make a lower wick. If the next candle makes a lower wick and starts to break the high, I'm going to be willing to take an impulse entry for candle to possibly continue up. And you all know where the stop is going to be, right? The stop is going to be below this current candle that breaks the high. That's what I'm really looking for. If the size of this candle is like 15 pips, like you have to gauge the size basically. But if, for example, right, and I've seen a lot of people make this mistake here as well. Let's say, for example, okay, let me just make this a little bit better. Let's say, for example, that the next candle is a big candle like this, right? And now the size of this candle becomes like 30 pips, right? This is the size, it's 30 pips. It has a wick on the top. A lot of guys are going to do is they're going to say, okay, what? If the next candle, it makes a lower wick and breaks the high right over here, I'm going to take a buy, impulse entry, because Raja thought this and Raja says this and this. No. You're forgetting the fundamental rule of market structure. And the fundamental rule of market structure is that whenever we're breaking a zone, the further away price moves from a zone, the higher the probability for price to retrace. Okay? We have to keep in mind. So whenever we have a bigger candle forming outside of a zone, don't try to take a buy right here. It may go up. It may go up. If it goes up once, goes up twice, now you're going to believe that, okay, it's going to always go up. And that one time, if it doesn't go up, and instead of going up, it starts to, like, let's say goes up, breaks the high, you take a buy, and it starts to go down, you're like, oh man, impulse entries are so tough, they don't work. They don't work because of the fundamental rule that the price has left the zone. Once price leaves the zone, there's a higher probability for it to come down for a possible retest. And this retest we've talked about in market structure as well. So you have to wait for a retest. So whenever you have a big candle forming outside of a zone and you haven't taken an impulse entry here, you're waiting for price to come down, do a retest, and then continue to push up. Now, this is where I start anticipating the first example to happen. Remember we talked about the first example? This is where I start anticipating the first example to happen. Let's say the next candle goes down, but it closes bearish like this. Now we all know what we're expecting. We all know the higher probability of the next candle. We all know how the next candle is going to form. Next candle, there's a higher probability to break this high and continue to move up, and that's your impulse entry right there. So whenever you have a candle that breaks outside of a zone and goes to a lot of pips, just wait for this scenario. That's all what you got to do. Wait for this. Wait for something to print that you understand. Wait for something to print that you can look and say, okay, you know what? I understand this. I've seen this before, and I can execute on this with confidence. Right? That's what you're waiting for. Another thing. Now, all these things that we're talking about from a bullish perspective, and it's 100% accurate if price is forming a bearish structure for a bearish perspective as well. It's 100% the same thing right here. Now, if let's say we have a wick here to the left hand side, right? We have a wick here to the left hand side, and you have the perfect candle that's forming, and that candle, like, you know, it has made a lower wick, and you're like, okay, you know what? We've made a lower wick, and once this candle starts to break the high of this candle, you're like, oh yeah, you know what? I'm going to take an impulse entry, and once I take an impulse entry, price is going to go up. I want to make pips, blah, 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 blah. No. What you're missing is that previously, this candle here was also bullish. It was also bullish, but for some reason, it got rejected. It got rejected and it came back in the range. So as this candle is breaking the high of the previous candle, there's a very high probability that it can move up, right? That it can move up, reject it, and make a wick like this. There's a very high probability that can happen. So you have to keep that in mind, right? What a better scenario would be for you to wait for a candle to close like this, to close in this area. What this will tell you is that previously we tried to break above this area, but we couldn't. The candle exhausted, went down in the range, rejected. But now we have this Robocop candle. I'm calling it a Robocop because something's strong, right? We're calling it a Robocop candle. Was so strong that it closed outside of that range. So when we closed outside of that range, and this is like, 15 pips, not that big of a candle, and the next candle wicks down and breaks above this high, there's a high probability we're going to go up. That's all what I'm looking at in this scenario for impulse entries. Okay, so these examples. Now watch over this virtual class again. You have to go over this again. And always keep very specific formations in your mind. And they do happen. And when they happen and you execute on them, it's a beautiful thing. Trust me, it's a very, very, very beautiful thing. So, always understand this, right? Impulse entries, the first time, you're not going to get them. The hardest thing about impulse entries is fearing of you missing the trade. Even if you miss the trade, that's totally fine. You don't have to chase the trade. You don't have to be in a trade just because you've opened up a chart and you got to be in a trade. No, you don't have to, because trading is a learning process, and impulse entries are extremely hard, right? Extremely hard. They're harder because you got to wait. They're harder because you have to wait for the candle to close. They're hard because you actually have to wait to see if the pattern is forming the thing that you recognize. Once you recognize a certain pattern that's printing on the charts, you're like, okay, like, you know what, automatically and naturally you're going to say, okay, you know what? I've seen this before, and I'm going to execute on this. And once you execute on this and you win the trade, you look on Instagram or Twitter or like, YouTube, and someone else took the same trade who you idolize or look up to, you're like, oh man, you know what? This is so easy. This is so easy. But in% trees, they always start from you just sitting and watching, right? Sit and watch price play out. It slowly comes with experience, slowly comes with anticipation, and the more you anticipate certain things to happen, I promise you, the better you're going to get at that. Now, we have three, again I mentioned, we have three other sections in market fluidity about impulse entries, but this right here, what we discussed, was the perfect scenarios that I want to see and different scenarios that we've seen in the market. Now, some scenarios have a higher probability than the other ones. So, normally, always adjust your risk. Always make sure the amount of risk you're going to take. Always make sure that the setup or the candle formation that you're executing on, it aligns with your risk management, right? So now, I would prefer for you to go over this class again, maybe 2 or 3 times, make notes and understand what you really want to see in the markets. Take care. Okay, this is a very special section. This is also one of the most complicated. It's not complicated in terms of technical analysis, but it's more complicated when you're trying to manage your own emotions and your own psychology when it comes towards really executing these ideas. Now, this is called how to give your trades a second chance. So whenever we're talking about how to give our trade a second chance, the main concept here is that you have to keep your bias the same, right? The first step is to always keep your bias the same. Now a lot of times what traders would like to do is they would say that, okay, I'm going to take a buy at this position, and they take a buy and price does this, weird liquidity grab, but it retraces more than you anticipated for it to retrace, and it hits your stop. Once you hit your stop, you're like, okay, you know what? I had a buy at this point. It hit my stop loss. I'm going to try to look for a sell. And once you try to look for a sell and you're selling, let's say your bias was correct, let's say your trend identification was correct, which was a buy. Now when you try to look for a sell, the trend continues and it continues up and hits your stop loss, and now you're lost 2 trades, right? And then maybe you try to take a buy after that and you get a small win, whatever, right? So now you have 2 losses. You took a buy, that didn't work out, and then you took a sell, that didn't work out, and then price eventually went exactly where you thought price was going to go. That has happened to a lot of people, and that used to happen to me as well. Now psychologically, that's very, very damaging. You lose confidence, it hurts your ego, or sometimes, you're in a buy position and price retraces, hits your stop loss, and then it goes exactly where you thought it's going to go. That's very, very normal. That happens all the time. Sometimes you can say, oh, well, even maybe I would have had my stop loss a little bit wider, or maybe like a lot of these things go into your mind. So the best thing to do at this point is to just step back and logically look at price, that okay, if price went into my favor, it went exactly where I thought it's going to go, how could I have executed on that, right? Like, what could I have done differently? Okay, maybe I could have looked for a second position, or maybe how could I have given my trade a second chance? And whenever you're looking at price in a way where you could have given your trade a second chance, there's always going to be a technical aspect to that, whether it's going to be a candle giving you a buy confirmation, or it's going to be a candle, giving you an opportunity for an impulse entry, which we've covered in the past. All those things are going to happen, and all those things are going to print exactly how you want them to print. Okay, so whenever you're looking at a trade and you're taking a loss on a trade, always understand this, that if price tends to go in your direction, there's always a way that you can give your trade a second chance, whether it's from a candle confirmation or it's that through an impulse entry. So we're going to go over some scenarios and some examples, and hopefully we can shed some more light on how to give your trades a second chance. So So in these examples, we're going to assume that price is in a trend, which it should always be in a trend, and you're trying to trade the trend because trend is your friend, and we're not going to fight the trend. Okay, sometimes you may get opportunities to fight the trend, but just don't fight the trend, right? It's just not profitable. So we're going to go over some examples, and this is only going to be when price is trending. So we're going to take a look at a bullish trend, and if you reverse that, it becomes your bearish trend, and the ideas are normally basically simple. So let's take a look at this right here. For example, let's say we have candles pushing bullish, right? We have a bullish trend, candles are pushing up some more, and candles push up some more at this point. And what's happening now is that now you're getting this sort of like resistance being formed up over here. Let's say you have some sort of a buy being formed. Now, just by looking at this, and trend is up, and I know some of you guys have gone through certain concepts and certain market structures and certain ideas. Do you think this is a great idea to take a sell at this point? Do you think? I don't think so. This is not a great idea to take a sell at this point, because for you to take a sell, so now this is basically all side note, right? For you to take a sell in a bullish trend, you want price to basically come down right here, maybe whatever, and then you want price to create some sort of a support if you want to take a sell. This is side note. This is not related to this section where we're doing whatever. So you want price to create a support. Once we create a support, let's say this is also a 30-minute time frame. Let's say we've created a support. Now, if price breaks the support, this is where you should take a sell. Counter trend trading. We've went over this. This is when you should be taking a sell. Okay. Now, so we're not going to go into more detail on that. We've already went into detail with this, right? So what we're talking about is how to give your trade a second chance. Now, let's say price is continuing to push down. We are pushing down, in an uptrend. We're making a higher low, and this is where we have created a support now, right? We've created a support, and price is pushing up. And let's say, for example, this is a 40 pip range. You have a 40 pip range, and you're saying that, okay, you know what, there's a high probability for price to go up, and you're looking at some sort of a confirmation, and this is your confirmation where the candle has closed bullish. Let's make this a little bit smaller, right? Candle has closed bullish. Everything aligns in your favor. 30-minute time frame, bullish trend, support formed, higher low formed, and there's a high probability for price to continue to push up, right? And that's where you're executing your perfect buy. Now, for example, let's say that price does not do what you anticipated it to do, and instead of moving up, let's say price wicked down, it broke above this high. Let me remove this. It broke above this previous high, and then price started to continue pushing down, right? And we formed a bearish candle at this point. What are you going to do at this point, right? We formed a bearish candle. Now, this is only provided that now here's the thing. Whenever you're looking for a buy or a sell, you're keeping the same bias. I cannot stress this enough. You're always keeping the same bias. If you're looking for a sell, you have a selling bias only if price is trending bullish, right? If price is trending bullish and you're only looking for a counter trend sell, you're waiting for the support to break and then you're taking a sell, right? If price is trending let's say bearish, then you're looking for sells or whatever. But if price is trending bullish and you're only looking for buys, you're only looking for buys. Never change your buys for anything. Never. This is the core value of trading right here. Never change your bias. Changing bias is only left for experienced traders who've seen certain things happen over and over again. So never, ever change your bias. This is the pro tip right here. Never change your bias. Now, let's say, for example, you took a buy and you took a loss at this point and candle closed like this, right? Now you're like, oh man, you know what? I expected price to go up. It didn't go up. What should I do now? The best thing to do at this point is to just wait to see if you have another buying opportunity, how to give your trade a second chance. Now, this may for some look like, oh, we can go down, blah, blah, blah. But let's say, for example, if we do go down, we go down, and your bias was bullish. So your buying opportunity never came, so you ended the trade in a loss. Now let's say, for example, you were able to manage risk, so you didn't lose the whole percentage, you lost a portion of that risk, and that's it, right? Loss is a part of the game, you manage your risk, you lost less than what you anticipated to lose, perfect, day closed, awesome, right? Now, for example, instead of moving down, we have a candle that goes bullish. Now this is very, very, very important. Let's say you have a candle that goes bullish. Now there are two scenarios, right? There are two scenarios that this happens. Now if we focus on just this idea right here, don't you think that we have a bullish candle and then we have a bearish candle right here? So we have a resistance form. Now note this down. If a candle closes bullish, but it's still below this resistance that we formed, this is not a good opportunity to buy, because we're still under this resistance. Now there are different scenarios that we're going to go over, right? So we have to keep making notes, right? If this is a resistance, we're closing below this resistance, this is not a good opportunity to take a buy. The best opportunity to take a buy would be, number one, if this candle closes above this resistance, and now you can give your trade a second chance. Now you can give your buy a second chance, anticipating the next candle to wick down and to continue pushing up, right? So, okay, so over here we have some confirmations. The first confirmation is that you have a bullish trend. The second confirmation is that we have formed support. The third confirmation is that the candle is closing above this resistance, which is now giving you enough probability for price to continue moving up. Now, another thing, side note, when are big moves supposed to happen? When can you expect big moves to happen? Can anyone answer that to me? Can anyone? There's no one here, it's only me. And you guys watching. Okay, so big moves only happen when there's volume in the market, right? And when do we have volume in the market? We have volume in the market, you have pre-London session, you have London Open, you have pre-New York, you have New York Open, you have NYSE Open, you have London close, you have news happening, you have breaking events, and all these times when there's volume in the market, right? That's the only way when you're going to have a big candle forming. Now, right, first situation, candle closed above resistance, now you have a very good opportunity to price to go up. Now, understand this. This is a wick, this is a big wick right here. We can form all sorts of candles, all sorts of things can form, you know, and this is a big wick. Whenever you have a big wick, we've talked about this in impulse entries, you can't take an impulse entry, because if you're waiting for this candle to break above this high, then your entry is going to be too late. And sometimes it's going to happen. Sometimes what's going to happen is that you're going to have this candle just move up, break above this high, and then continue to go up. Okay? Now, was there an opportunity over here for you to give your trade a second chance? Your trade has to make sense, right? Logically, market structure, the way the candles are printing, they have to make sense. It's not all the time that you're going to have an opportunity to give your trade a second chance. It's not going to happen all the time. Sometimes it's going to happen. Well, I would say most times it's going to happen. I'd say maybe, you know, the probability, maybe 80% of the time, you're going to have an option to give your trade a second chance. The 20% of the time, you're not going to have an opportunity to give your trade a second chance. So this is when you're going to not have an opportunity to give your trade a second chance, because as we mentioned earlier, if this is a 40 pip range and now price has broken above this area, is this a good idea to take a buy at this point? Right? What did we learn in the previous sections? Is this a good idea when price is in the middle of a range? It's not. You know, a better idea would be for price to maybe be closer to this zone so that there's a high probability for it to continue pushing up. This is a situation where it may not work, and I really hope you guys are taking notes. Okay? Now, for example, let's say this wick right here, it was this big. You know, it wasn't that big of a wick. You know, it was this big wick, and if the next candle starts to break above this high to the left hand side, you can take an impulse entry. Because if we're now breaking above this high, we learned in impulse entries that this is now a really good probability for price to continue pushing up. Okay, this is a really good probability for price to continue pushing up. This is where you can give your trade a second chance. Second chance is that you give the first chance right here. After this confirmation, didn't work, you got stopped out, and now you're waiting for price to break above this high, and now you're giving your trade a second chance. Now, when you're talking about risk, let's say you're only giving your trade a second chance if you still have risk left in your day. That's why managing risk is really, really, really important. Let's say your total risk for the day was 2%, and you took a trade right here. Let's say you put like 1% risk there, and you manage risk. Instead of losing 1%, you lost 0.8%. So you still have 1.2% risk left. And now now it's up to you whether you want to use the full 1.2% risk or you want to use, let's say, 1%, 0.5, whatever. That's totally up to you. But in essence, this is where you're giving your trade a second chance. And this also means that you're taking a second trade. Essentially, it's just a second trade. You know, your first try didn't work out, so now you waited for your second confirmation to show up and you tried to give your trade a second chance. Okay, this only happens when price is trending. This only happens when there's volume in the market, right? So there are different situations, there are different ways that the candles can print and can give you these ideas that this may work in your favor. Okay, so we have to keep these things in mind. Giving your trade a second chance is a complicated idea. It takes a lot of practice. It takes a lot of sitting around and watching what price is doing, because here's the thing. Whenever you're going to take a trade, and in your eyes and in your mind, it's going to be a perfect trade, a perfect opportunity to execute. And if price doesn't work that way, all these emotions come in. All these emotions, you're thinking that, oh man, shit, I took a losing trade. Let me take a sell. Let me take a sell over here and win this trade because it's going down. No, keep the bias the same. Just relax. Calm down. And the first way to calm down is to manage risk. If you know that you have managed risk, if you know that you risked $100 and you've lost, let's say, $80 and $70 trying to take a buy, now you're perfectly fine. You're like, okay, you know what? I managed risk and I'm a mature, confident trader. I'm going to sit back and I'm going to see if price gives me a second chance for it to continue pushing up or not. Okay? And this is where these situations are where you can give price a second chance for it to continue pushing up. Okay? Now, there's another situation that happens, and we're going to talk about that as well. There's another situation that happens that, let's say, for example, we have support formed. We have support formed, and the next candle, you know, it forms and it breaks the high. You're like, okay, perfect. We've broken the high. Now we're going to go up. But instead, it starts to break down. It breaks the low right here, and it still closes bullish. Okay, so we have a bullish candle closing. Let me make this a little bit better. That's not a bullish candle. That's a weird looking bullish candle. We have a bullish candle closing like this, right? We have a bullish candle closing like this, and you're like, oh man, you know what? I had to buy at this point. Price broke the high. I took a trade, and price came down. My stop loss was right here, and it hits a stop loss, and now I have a loss right here. And while you're crying about that loss, you see the next candle wicks down and continues to push up, and you're like, oh man, shit! Like if it didn't have hit my stop loss, I would have had a profitable trade. Now, just at this moment, a lot of you guys are thinking the same thing that I'm thinking, that okay, if you took a loss right here, and if you managed risk, and also remember, there's always a probability you're going to be able to manage risk. You're not going to be able to manage risk all the time. You're going to be able to manage the risk most of the time, and sometimes you're going to take the full risk on the chin, and that's totally fine to solve our probabilities. Now, you're thinking at this point is that, okay, maybe if this candle broke above this high, we could have taken an impulse entry and given that trade a second chance. And that exactly what we thought it was going to do, because now we gave a trade a second chance and we made some money, or we reduced some of the loss we had over here or like, we put the risk that was left from this trade over to this trade, and now it basically worked out. Okay, so these are different scenarios, different things that can happen, and these are things that you notice in the market as you're trading them, because as you're sitting back and watching how price is moving, you're looking at candles, you're looking at the different way the candles are printing, and you're kind of like visualizing where you can see the next candle move, where you can see the next candle go. And once you start to do this for like 3 months, 4 months, you start to have an intuition, is what I call, right? This intuition comes over time. Like after watching all we've done over here, you're not going to be able to do like, or to give your trade a second chance maybe by tomorrow or next week or the week after that. It's going to take you like maybe 1 month or 2 months to just kind of like really absorb the information and keep watching how the candles are printing. And then you're going to be able to successfully give your trade a second chance. But listen, in the beginning, I wouldn't recommend for you to just jump in giving a trade a second chance, right? Take those losses, but manage your losses. And once price does something that we've discussed here, just take like a mental trade. Take like a mental trade and watch it. And don't take that mental trade stressing about, oh, I could have been in this trade. That's totally fine. That's totally fine, because you're still learning, you're still progressing, you're still adding these tools to your trading arsenal for you to be in profits in future, right? So this is all mental investment that you're doing in yourself. So later on, once these situations happen, you're going to be able to execute on these, and someone new is going to look at you and say, oh, hey man, how are you able to do that? And you're going to say, oh, well, it's easy. Just give your trade a second chance. And they're going to say, oh, how? So these situations can also happen. Now, there's another situation that happens all the time is when, the next candle breaks below the low and just continues to push up. These scenarios are where you can't really give your trade a second chance because there was no confirmation. And always remember, whenever you're giving a trade a second chance, there needs to be a confirmation. There needs to be a logical way where you can execute that trade. Okay? Very, very important. Giving your trades a second chance. And also rewatch this, right? The rules were you have to have the same bias. Don't change your bias. Changing your bias is going to be very, very risky. It's going to be detrimental to your mental health. It's going to be detrimental to your trading psychology as well. Never change your bias. I have a lot of people who can successfully give their trades a second chance. So there are different scenarios that we discussed over here. So what we're going to do now is we will go over how to add risk back to your trade. So we're going to go over that. How to add risk back to your trades. Give their trades a second chance. So there are different scenarios that we discussed over here. So what we're going to do now is we will go over how to add risk back to your trade. So we're going to go over that. How to add risk back to your trades. Let's take a look at this right here. Now, this basically fits in perfectly with giving your trade a second chance. So we're going to talk about that, how to add risk back. Now, whenever we're talking about how to add risk back, it's basically after we've basically managed risk, and when price starts to go back in our favor, that's when we're saying that, okay, we're going to add risk back to the trade now. So let's take a look at this. All right, so in this case, we're going to talk about, so we're going to go over some, like a bearish trend. Let's say we have a bearish trend, price is coming down. You have a bearish candle, and then over here as well, you have a bearish candle coming down, coming down. We have another bearish candle, move down, another bearish candle, move down. And then we have a bullish candle forming. We start to go up, We've created a, let's say, a hypothetical support. We have another bullish candle that goes up, and that's basically it, right? And then we have a bearish candle forming. Boom, resistance formed, trend is down, you're anticipating the price to go down. You're basically, this is, let's say, a 40 pip range, and you're anticipating price to continue pushing down. Now, all of these scenarios, they do happen when price is trending, right? So in this case, price is trending bearish, and this is what we're going to go over. So let's say you take a sell, and instead of pushing down, price starts to go up. Now, the most important thing here is for you to really understand how managing risk works, right? And that's what we've explained in the risk management section, the third one, and also in the risk management 3.0 in market fluidity. So you have to go over that first, okay? You have to go over that first. Now, for example, let's say we're looking at the 30-minute time frame, right? We're looking at the 30-minute time frame, and let's say all the 15-minute candles are also bearish. So let's say this 30-minute candle consists of two 15-minute candles, which are basically, you know, like this. You got two 15-minute candles that are basically like this. You take a sell at this point. You've taken a sell, and price wicks up. When price is wicking up, and in this on 15-minute, let's say price is wicking up and moving up, once it starts to break the high of the previous 15-minute candle, you're like, oh, okay, wait a minute. We're breaking the high. Maybe at this point, if we, now two scenarios, right? One, if we close bullish, I have to manage risk. Or if it breaks the high, I have to manage risk. So you're managing risk. You're closing 50%, right? You close 50% risk right there. Let's say you had a one lot. You're closing 0.5. So now you have 0.5 left open. You have 0.5 left open. You're like, okay, you know what? I don't know. I don't understand whether the price is going to continue to push down. It's going to push up. So either way, you managed risk and you closed 50%. Once you've closed 50%, now you're waiting to see how price is really going to move, right? So let me remove these lines over here because we're going to be using this as well, right? So let's say now the 30-minute candle, it starts to close bearish, and what it looks like over here is that the 15-minute candle, it starts to push on, moving down. Now we've closed bearish here on the 15-minute, and as you can see now, we've created a minor support on the 15-minute, okay? We've created a minor support on the 15-minute, and also the 30-minute candle is moving down here a little bit too. So when we're moving down in the scenario, now you can look around and say, okay, hey, wait a minute. I still have, let's say, a 0.5 lot running, and if the next 15-minute candle breaks the low of the previous one, maybe I can add the risk that I closed. So in this case here, you can add your 0.5 lot back, you know, and your stop is either going to be, it can be above the 15-minute candle, or like, you know, it can be above the current 15-minute candle that's just forming and breaking below the low. Now, there are a lot of things that can happen here, right? This 15-minute candle, you need to have volume to push price down. And this 15-minute candle can just move down without making a top wick in the first minute, first 5 minutes, 3 minutes, 4 minutes. So that's all on your intuition. That's all on your judgment, how you're going to perceive that. But this right here, we're talking about the fact that once we've made a top wick and we've broken the low, that's the perfect scenario to add risk back to your position. As we start to break the low, you can add position back. You're like, okay, you know what, I'm going to add it back. And on 30-minute, it looks like price starts to go down. Okay, but the most important thing is that you are managing risk. You're actively managing risk, and once price starts to form in your favor, you're adding that risk back. So that's how it works. And there are also various variations to this. The number one variation is that if, let's say, for example, let's say the 15-minute candle broke above the previous high, and the new 15-minute candle, when it forms, it just starts to drop down. You know, once it starts to drop down on the 30-minute, it kind of looks like this. Okay? When this happens, there's basically when this happens, there's basically no way for you to add risk back. If you look at this, right, because the 15-minute candle, this broke above the high, you manage risk. Next 15-minute candle broke below the low, and it moved so quickly, you're like, oh man, I couldn't manage risk, so I took the trade, whatever I could take. That's why sometimes you can see if you're going to have a one lot and price moves, let's say 100 pips, and you've managed risk here, you, instead of making $100, you make like $50 because you let the 0.5 run till, 10 pips or whatever. But some people are more advanced. Some people are more, experienced. So what they're going to do is they're going to say, okay, you know what? If the 15-minute candle is breaking below this low, and 15-minute candle breaking below this low also means that the 30-minute is breaking below its own low as it starts to go down. That means with volume, there's a higher probability we can continue to push down, and that's where they can probably take an impulse entry to say that, okay, we wicked up, I managed my risk, now we're breaking below this minor support, impulse entry would make sense, so I can add risk back to this trade for price to continue pushing down. Make sense? So you have to re-watch this again. You have to go over this. You have to look at examples. The best thing to do is to look at all the losses you've had in the past, all the losses, and look at those trades and then really ask yourself that, okay, if I took a loss in this scenario, where could I have given my trade a second chance? What could I have done differently so I could have given my trade a second chance? Or there are also multiple scenarios where you managed risk and price still went in your favor. Now, sometimes people over-manage risk, right? Over-managing risk is that you're going to basically close 50% right here, and then next time it goes up, you're going to close another 50%, and before you know it, you only have like 10% running, and 10% that runs, that profit sometimes isn't enough to cover the loss you had closing in negative, okay? So over managing risk, don't do that. If you're going to over manage risk, do it only twice. Close 50% once, then close 50% twice. That's it. Don't close more than 2 times, because if price is going to go in your favor, it's going to go in your favor after that one time you manage risk. If it's going to go in your favor. If you manage risk the second time and it still doesn't go in your favor, just close the whole position. There's no need for that, because if price then goes in your favor later on, you can give your trade a second chance. Make sense? Right? It's all logic. So go over this virtual class right here. Go over these classes. There are different scenarios that happen, and also remember, adding risk back to the trade and giving your trade a second chance. They go hand in hand. They are very, very similar. They're very, very similar ideas. Giving your trade a second chance and adding risk back to the trade. They are very similar ideas, and you have to wait for candles to print exactly how you want to see them printed. Now, for example, some things can also happen like this. Let's take a look at this right here together. Sometimes what can happen is that candle is closing bearish, and you're like, okay, candle closing bearish, I'm going to take a sell over here. You take a sell here, and what happens is that next candle, it breaks above the high of the previous candle, right? You get stopped out, and then the candle forms like this, a weak bullish candle. A candle forms like this after you get stopped out. After you got stopped out, and we're still in a bearish trend, and we're still closing below this resistance. Remember, this is a resistance, right? If we're closing below this area, now you know what's the high probability. The high probability is if the next candle wicks up and it breaks below the low of this candle, we all know what's going to happen. There's a high probability with volume we can continue to push down. And that's where you can give your trade a second chance as well. Right? Impulse entry. Most of the time, impulse entries are great to give your trade a second chance, adding risk back to the trade, and so on and so forth. Okay, but the main thing is you have to wait for candles to print exactly how you want them to print. That's very, very important, because you have to see the exact scenario and then you have to execute on this. Because remember, guys, you're trading with money, and this is real money. You can't play around with your money. You have to wait for candles to print exactly how you want them to print. Sometimes, we can look at the candle and say, oh, I have a feeling it's going to move a certain way, or I have a feeling it can go in a certain direction, so let me just take that trade. Low risk trade, but let me take that trade. But once that trade doesn't work out, your ego's hurt, your confidence is hurt, and things basically go downhill psychologically from that point. So you have to always wait for candles to print exactly how you want them to print. All right, again, remember, giving a trade a second chance and adding risk back to the trade, they go hand in hand, they work together, okay? Whenever you take a loss or whenever you manage risk and you're like, okay, you know what, I've managed risk, now I'm ready to, accept the risk that I've taken in the beginning, and the price doesn't stop you out and starts to go in your favor, you're looking at different scenarios to see that, okay, does this make sense where I can give my trade a second chance? Because remember, it has to make sense, right? Whenever you're giving a trade a second chance or whenever you're adding risk back to the trade or a potential move, it needs to make sense from a technical perspective. Also from market structure, it has to form in a way that you recognize that it does work. Now, again, as I mentioned, it does take time. It's not going to happen overnight. You're not going to get really good at it maybe in the next week. Man, I'm not even perfect at it. I'm still sometimes, when price goes in my favor, I'm still kind of hesitant to maybe give it a second chance, but I still do. Most times when I still do, it does go in my favor. Sometimes it doesn't. That's the probability of trading. So you have to give it a chance. You have to just watch how price moves. Whenever you take a loss, step back, relax. If you managed risk, be happy about it, because a managed risk trade is a winning trade because you lost less than what you planned on losing. Now, go over these things, go over the section again, and look at your losses, look at the trades where you closed early. Now, sometimes guys ask, hey man, listen, like I closed my trade early, what could I have done? And the answer is very, very simple. Whenever you think you should be closing your trade early, close, let's say 90%, or close like 50%, whatever, right? We've discussed that as well. So take care everyone, go over this section, and always go over your losses, and you're going to be surprised how many things you can find in them. Take care.